This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Five very smart men that all have a very tight niche in trading psychology, investment psychology. Look, I have some of the brightest psych minds on this show, the top people from around the world. But these five guys today, they take their expertise in the psych field to trading, to investments. These five really don't need an introduction if you've listened to my show in the past. But let me give some brief synopsis. Number one, Brett Steenbarger, one of my favorites. Brett is the author of The Psychology of Trading and other books. I'm not going to name them all. You'll have to go read them. My second guest today, Jason Williams, the author of The Mental Edge in Trading. Jason also happens to have a very interesting father. That would be Larry Williams. Great stuff from Jason. Number three, and he needs almost no introduction in this space. That would be Van Tharp, originally profiled in the book The Market Wizards by Jack Schwager. Van is the granddaddy, so to speak, of this space. Number four, kind of the young guy, Daniel Crosby. His book, The Laws of Wealth, is absolutely worth checking out. And last but not least, Meyer Statman. Meyer is a professor of finance at Santa Clara University and a behavioral finance expert. His book, one you should check out as well, What Investors Really Want. If these five guys don't change your perspective in some positive way, retire. Check out. You're done. It's over. If the interior of your mind, the 6 inches between your ears, if there's not some positive movement in there, additional electrical charges after this mega Trading Psych episode, I've got no more help for you. Let's jump right in first, starting with Brett Steenbarger. I've seen you make the comment, you're paraphrasing, you're quoting from Bobby Knight, and I'm guessing you must be a fan to some degree. Why do so many of us have the burning desire to succeed, but not the drive to prepare for the success? Before you answer that, I want to add one thing to that. Do people really have that burning desire to succeed?
It's a great question. I do believe the majority of traders go into trading with ideas of success. Now, those ideas may be fantasies, they may be plans, but they're drawn to trading in large part, for the outcomes. The problem that often occurs, and I see this more among beginning traders than experienced ones, is that part of what draws them to trading is the allure of not working a standard 9-to-5 job, and that it seems to them that this could provide relatively easy riches. And of course, as you and I know, it's much more than a 9-to-5 job when you do it right. The fantasy of the easy riches collides with the reality of what you need to do to prepare to win. And I think that creates quite a dissonance for many beginning traders and ultimately leads them to leave the field.
So is it a burning desire more for it's a burning desire for the outcome, but not too many people will take the step back and say, okay, hold on. And maybe you get into it, you say, I just see the outcome. And then you get into it and you take a step back and you start to break these pieces apart and you say, hold on, we can't just focus on the outcome or we will go crazy. We must break this down. We must look more at our process. Why don't you talk about that? Because I've seen you in some of your recent work, and I would love for you to draw some distinctions here from process to practice to process. Break that apart in how you're describing to clients and people that read and follow your work.
If I can address the earlier point, which I think is a good one, the distinction I like to make is between those who have a self-proclaimed passion for trading and those who have an enduring passion for markets. Those two are very different, and the person with the passion for trading wants to trade and ultimately ends up over trading. But when markets are closed, there's nothing to generate passion. That's very different than the person who has a passion for markets, where it's more of that process interest of understanding, unraveling, reverse engineering what's going on in markets and figuring out ways to better exploit that. So I think those are very different motivations and end up with very different consequences for traders. Your second question about practice and process, to me, is essential. And that's really what one of the big factors that got me to write this latest book of mine, the Trading Psychology 2.0. So often, you hear traders talk, and again, I see it more with the beginning traders. You see traders talk about finding your edge, sticking to your edge. All well and good. However, that, of course, doesn't take into account the reality that markets are ever changing and that finding your edge is a continual process, that as markets change, edges, sources of edge, evolve. And so we always have to be evolving ourselves. The way that happens in the medical world, where I came from, is through identification of best practices. What are the practices that lead to the best outcomes? And then turning those best practices into robust processes so that the best practices become habit patterns. They become automatic. I think that analogy in evidence-based medicine is quite apt for trading. We want to find the drivers of our success, what makes us successful, and turn those into processes that become replicable.
I'm going to break apart some of the big picture issues in your current life, your current world, your current work. But as you mentioned, markets always changing. And one of the lessons that you talk about and being around so many traders, studying, teaching, training, is adaptability. And literally from the beginning, if one strategy is not predicated on being adaptable to the markets, and the markets are the driver. We can't control the markets. And so whatever the markets must do, and they will do something, adaptability is number one, isn't it?
Yeah, absolutely. A great recent example that I've written about is in your area of expertise, Mike, and that's trend following. Trend following, as it occurred in the late 1990s, is quite different from trend following right now. There are portfolio managers and traders I work with who are trading trends, who are trying to identify trends to trade, but the way they are executing on their trend trading is more similar to what happened in the late 1990s, where they are confusing, I would say, trend with momentum. So that if they're long, they're buying strength. If they're short, they're selling weakness. What we've seen recently are markets that show anti-momentum in the short run, even as they are trending. A different way of saying that is that the trends have a lower Sharpe ratio. How you implement a trend-following approach requires adaptability. You may stick to your basic orientation to markets, i.e., trend following, but how you make that happen, how you put it into practice, has to be based on outcomes and your study of markets. That's where the adaptability comes in.
You know, it's an interesting point that you bring up, and it gets even more complicated as the numbers of large funds that we all read about, that we see the headlines, we see the quotes from, trying to decipher, when you read about a large fund that's managing billions and billions of dollars, and let's say that they started off as a trend following fund, and perhaps they still have billions and billions of dollars still as a pure trend following trader. But there are many funds today where they're adding other things and they're adding other strategies. That raises up a whole different issue, which is really one, in my humble opinion, not really of markets, and it's more a result of clients. Because when I talk to the pro trend following traders, if you talk to them on the record for public consumption, they're going to talk about a certain way, and it really is an appeal to clients. You get them off the record, when the microphones turn off, they're just like, oh my gosh, it's such a pain in the neck to deal with clients that don't understand our strategy.
Yeah, that makes a lot of sense. And I think for a fund, diversification makes sense, and having multiple approaches. And so there may be trend following approaches, and there may be relative value approaches, and so forth and so on. I think having diversified sources of return is a good thing for investors. One of the things that I've seen in the fund world is that investors have very limited appetite for the downside. And I would say that's been true ever since the '08 debacle, that they want to see funds make money, they don't want to see funds lose money. And so funds are managing risk much more tightly than in the past. So that even though in name they may be trend followers, in fact, any wiggles against the trend, that lower Sharpe ratio that I mentioned, ends up getting them out often at the worst possible times. So that sometimes it's the business pressures and the pressures of risk management that make it difficult for a trader to implement their strategy.
I would also advise clients or people that are interested in a subject like trend following. We're going to talk about a lot of different aspects of trading psychology today, but sometimes the performance proof, you can go to those track records. Those track records often have remarkably insightful data about them. And you can look at those track records, and I can think of some names, and you look at those track records and you say, wow, they've stuck to their religion, so to speak, for decades. Then you can look at some others and you say, you know what? A very consistent return number every month is just not trend following, even though it might be advertised that way. So I think it's really incumbent on individuals to do their homework and really try and find out, because sometimes the public pronouncements don't match the performance data.
It's a great point. And one of the downsides of having so much computing power and software power right now is that it's relatively easy to backtest strategies. With enough iterations, you can find randomly a strategy that will look good not only on the backtest, but on out-of-sample performance. So it looks like a very smooth, wonderful, ideal P&L curve, but of course that doesn't match the reality of real-time returns.
You do bring up a good point, though, about the backtesting. I mean, backtesting and trying to, if you're in the systems world of some type of system, a backtest, that's where it all starts. And I'd like for you to lead this into a broader subject area, which is preparation, because so much of elite performance really starts at that research level, that preparation level, that backtest level, and the ultimate execution often can be very quick or can occur in a fast manner, but it's all that prep time, that real deliberate practice is where the gold is made, so to speak.
I think so. And as I mentioned in the Trading Psychology 2.0 book, the key in performance fields is that elite performers, spend more time in preparation than in actual competitive performance. That there's a lot of practice time that goes into the curtains being raised on a Broadway play. There's a lot of practice time that goes into the first game of a chess tournament. And that preparation works at two different levels. It helps develop a strategy, an approach, and it helps prepare the performer mentally, psychologically, emotionally. That preparation time, I found, is correlated with success to the degree that it pushes the trader to expand their horizons and develop the best of what they're doing.
Let's just talk about pro traders for a moment. You've seen pro traders at the highest levels. Why don't you draw some contrasts? For example, I think the audience might have a hard time imagining that there are some pro traders at the highest levels, perhaps, maybe with long track records, perhaps a lot of money under management, and the way they go about practice might not be nearly as good as one of their peers who might have deliberate practice down to a science. Everything is really thought out. There's some contrast, even at the highest levels, isn't there?
Very much so. I'm really blessed by being able to work with a number of very talented traders and very successful firms. In fact, the smallest firm that I work with has about $3 billion under management. So, traders in those kind of firms have to do something right and have to have some real strengths to get to that point of managing significant capital. But you're right, even within those funds, between PMs, there are real differences in the preparation approach. And I would say there are two sources of difference. One is the one that you mentioned, the difference between repeated experience and deliberate practice. Some managers of money, some traders really rigorously keep score, and they try to learn from their trading. And what did I do wrong? What could I improve? How am I going to improve it tomorrow, next week? So they're constantly keeping score, setting goals, and then keeping score about whether they reach those goals or not. That's the essence of deliberate practice. The second thing that distinguishes the successful traders is the emphasis on what they do right, their strengths. What positive psychology research is telling us is that it's leveraging our strengths, not just shoring up weaknesses, that accounts for elite performance. And so we want to figure out, what are we doing well? Because those are the practices that will anchor our best processes. And so in two different respects in preparation, identifying what we're doing wrong, correcting that rigorously, identifying what we're doing right, and turning those into best practices, that is real preparation.
I only brought it up because it was in your work most recently, but deliberate practice, I'm my fingers crossed. Anders Ericsson has said he will come on in 2016 to talk about his seminal work, so I look forward to that. Let me drive back at the strengths aspect for a moment. So let's say we're kind of giving advice to the new trader at the table to some degree, and let's say we're kind of talking more of a system mindset. And I think these days, most everything is a system to some degree. I mean, even if it's a discretionary type thinking, there's a system behind it. But talk about strengths, because it seems like to me, one doesn't really have the ability to think too much about the strength they have. Let's say you're going to be a systems trader. As a systems trader, you have to have your entry-exit criteria. You have to know how you're going to manage your portfolio. What's the risk management strategy? You can't just leave one out. So I would love for you to kind of elaborate more on the strengths part, because it seems like you're saying, and I could be reading this wrong, that we all have there's some built-in strength about one aspect, and to kind of really focus on, correct me, what am I missing here?
Well, no, I don't think you're missing anything. I do believe that the strengths that make a good systems trader are different from the strengths that make a good discretionary trader. So much of the success of systems pertains to the research and the quality of the research that's conducted. And so, in some ways, the strengths that are relevant to a system trader are not so different from the strengths that are relevant to a medical researcher. The information you take in, how you process that information, how many variables you look at one time, and how you weight those are all part of what can be best practices. There are also strengths interpersonally. Many times the research is too complex to be conducted individually. I work with some people who develop relatively high frequency systems. And those systems are developed in teams. There are programmers, there are quants, there are traders. And so being able to work well with others, those are strengths that are very relevant to best practices and to ultimate outcomes in the systems world. For discretionary traders, strengths are different and often pertain to the amount and type of information that's taken in, how that information is translated into tradable ideas, how those ideas are expressed as positions and managed as positions, including the risk management. And of course, there are best practices related to not only risk management and position management, but self-management, how we take care of ourselves. All of those go into making someone successful. There's no one process of trading. Trading consists of multiple intersecting processes.
I brought something up a few minutes ago. I talked about some of the big things that you've learned from all the traders that you've looked at. I mentioned adaptability, creativity, productivity, and self-management. Why don't you talk about creativity for a moment? I have a feeling for many traders, just even entrepreneurs, venture capitalists, creativity for those that are in the business, they probably think of it as instinctive. It's something I do all the time. But defining creativity like you've done changes the ballgame a little. It forces us to think about the word creativity. And I don't necessarily know that a lot of people would immediately think, oh, I have to be creative to be a trader.
Yes, to the degree that we regard trading as a business, then I think it makes sense to say we have to be doing something unique in order to be superlatively successful at this business. If I open a hamburger stand that's just like every other hamburger purveyor, then how am I going to achieve a significant degree of economic success? I have to do something different, unique. And it's in that difference, that uniqueness, that creativity comes into play. We see that in financial markets because many times the herd is following a similar set of strategies, looking at the same information and processing it the same way. And that's why you see swings in sentiment that often end up being relatively good contrary measures. That's why you see many people getting hurt at the relative tops and bottoms of markets, because they are doing things that really are not unique, not creative. It's particularly an issue in the professional money management world, where there tends to be a high correlation among financial markets. The Financial Times had a piece on that recently. There also, as a result, tends to be a high correlation of returns among portfolio managers within a firm and across firms. And so that is a problem for investors. Investors want to diversify their capital. A trader who has the creativity to examine, test, and implement new strategies is going to be very appealing to anyone who invests and wants that diversification.
You know, you just mentioned, you said, well, clients want the diversification. And we talked earlier about, you know, sometimes clients actually, they might say they want diversification, but then they're doing anything they can to avoid volatility, to avoid taking excess risk. And I was thinking, as you were just talking about, okay, so many investors, traders, they're looking at the same info. They're processing that information in the same way. There's nothing unique about it. And they're simply fixated on comfort. And as you point out in your work, it's the adaptation. It's got to hurt a little, the hurting a little, or maybe even hurting a lot. That's where the reward often is. In some kind of perverse sort of way, that desire for comfort can set one up for, as Nassim Taleb talks about so much, the black swan. So comfort's often illusion, isn't it?
I agree with you, and it's hard to imagine us extending our boundaries, really transcending who we are, if we aren't willing to go outside our comfort zone. That can be done in a variety of ways. It can be done by looking at new markets. It can be looking at existing markets in new ways. It could be looking at new and different time frames for implementing our trading. There are many ways of doing things new and different. One example from my own recent trading, it has been a redefinition of volatility. I find that volatility is very important to market returns, and in the models that I create, volatility ends up being an important variable. As we know, with stocks in particular, volume and volatility are highly correlated, so that markets move more when there's more participation, which makes sense. But I got it in my head, well, what if I looked at volatility a different way? What if I looked at the volatility of a given amount of volume in the market? If X number of shares trade or X number of contracts trade in the market, how much movement is associated with that amount of volume? You're disaggregating the relationship between volume and volatility, which I call pure volatility. And it turns out that that has real value as a variable for understanding markets. Because when you see volume expanding, and when you see the movement per unit of volume expanding, you can get some very big moves. That's an example of creativity, looking at something similar in a unique way.
We've been talking about markets, how markets are the drivers. But at the end of the day, yes, markets are the drivers. We as individuals have certain built-in, and I want to kind of let you break this apart. We've got a certain personality. We've come to the game with something. We behave in a certain way. We think in a certain way. We react in a certain way. Our emotions go a certain direction. But I find the word personality is often difficult. And I know you point out, and correctly so, and Jack Schwager has said it for a long time. He said, you got to trade your personality. But I think for a lot of people listening, that might be really hard to digest. You say, well, hold on. I don't necessarily even know how to define my personality in any kind of a rigid or quantifiable way. One could go out. There's several personality tests out there, or personality instruments, shall I say, since I am actually qualified to administer the Myers-Briggs instrument. It's not a test. So, but that can be confusing, and there could be debates about that. So why don't you break apart the word personality from your perspective and give some guidance to the audience out there that's thinking, man, I might not even be sure what my personality is. And if I do know, how do I make the decision to go which direction? It becomes a quite complicated conundrum to figure out, doesn't it?
Yes, I agree with you, and I think it's even more complex than your question implies, because as you mentioned earlier, it's not just personality traits, it's also our cognitive style, how we think about things. We have personality traits, emotional traits, we have cognitive traits, and so we want to leverage our strengths in both of those domains. Again, I think that reverse engineering the success of our trading can provide some real clues as to some of those strengths, some of those signature personality and cognitive strengths that would contribute to our success. What I found from the research I've done with traders is that average holding period ends up being a very important variable, particularly on the cognitive side. I would make a distinction psychologically between a trader and an investor. The longer time frame necessitates a higher degree of underlying research, and the longer term research becomes really the focus of the trading, of the market participation, not the day-to-day movements of the underlying assets. That's a very different set of strengths from, let's say, the day trader, the active day trader, who is looking at markets moving rapidly, is seeing patterns set up very quickly in markets and trading those patterns. So there's very little explicit research, reading, calculation. It's all about fast pattern recognition. The distinction that has been made between thinking fast and thinking slow is very relevant there. The deeper thinking, the faster pattern recognition. And as Kahneman talks about, those are really two different brain functions and two different modes of processing information. Now, in addition to that, we could distinguish two types of trader or investor, personality-wise. One is highly risk-taking. They tend to be more outgoing, more extroverted. They tend to be more stimulation-seeking, more aggressive, and are willing to take more risks in the pursuit of higher returns. The second group of traders is less interested in absolute returns than in risk-adjusted returns. They're less risk-taking. They're seeking smoother P&L curves, higher Sharpe ratios, and very often are seeking what we would call alpha rather than beta. They tend to be more analytical in their cognitive style. They tend to be more introverted in their personality style, and so a very different approach to markets. Those two dimensions, the holding period, the research orientation versus pattern recognition orientation, and the element of risk seeking versus risk-adjusted return seeking are just a few ways people could think about personality and cognitive style and how that might relate to some of their strengths.
Brett, I know your job is not necessarily to offer a personal opinion about what I'm going to ask you, but I'm curious because you just mentioned the phrase smoother curves. And if I think back over the last 15 years, we've had two, if an investor, if they classify themselves as an investor, just a kind of a buy and hold approach, an index type approach, we've had two 50% drawdowns in the S&P. I think it's reasonable to assume that if that's one strategy to trust the S&P, it's reasonable to assume that could happen again. And now, of course, when it comes to trading strategies like trend following, smoother curve, if somebody says they want to be a trend following trader and they want a smooth curve, I would say, well, then you've got the wrong strategy. There's no such thing. But is there really a smooth curve for anybody? Except, as you mentioned earlier, and you didn't say this, but the pro high frequency traders that can generate, I think I read a couple years ago, one of the big iBanks, is literally they made money every day of one quarter. So, but I don't even know if that's trading. That's technology, that's infrastructure, that's access. That's not a competitive thing where I can compete against JP Morgan on the high frequency level. I can't. But talk about that for a second, the idea of a smoother curve. Is that just a false ideal, a false goal?
Not at all. Not at all. I think for any one strategy, the P&L curves are likely to be bumpy. And as you point out with the S&P, for instance, if one were simply an index trader. However, the idea of smoothness of P&L curves is really all about diversification, portfolio construction, and combining different approaches to markets to balance the returns. The basic risk parity notion of buying a volatility-weighted basket of interest rate instruments and equity instruments would be a case in point that in recent years, that basket has had a smoother P&L curve than either asset individually. You could expand that more broadly to a basic asset management approach. For instance, if you think about returns as being generated by certain factors, trend or momentum could be one factor, value could be one factor, carry could be another factor, then you can combine investments or trades that express those different factors and that harvest returns from those factors in a smoother way than if you were trading one strategy in isolation. And so asset management in general as a field, I think, is all about achieving smoother returns, more unique returns, rather than chasing beta from any given market.
Yeah, I was definitely just speaking to one strategy. I think you're right. Once you add in multiple strategies, the notion of trying to find a smooth curve is completely, that's the goal. That's what many people do, I guess. But in the notion, I think if some people think they can find a smooth equity curve from just one strategy in isolation, that might be very difficult.
I agree with you. Probably the Bible of the asset management world would be Antti Ilmanen's book, Expected Returns, and very much worth reading about, because I do think that there are things that individual traders can do to improve the smoothness of their returns. Even as you say, they can't completely smooth them. There's always going to be those bumps in the road. A very simple example would be trade expression, that a given view in a given market may have more favorable risk reward if traded with an option structure than if traded with an asset outright. There are ways, I think, of achieving better risk reward, but that doesn't eliminate the potholes along the way.
For all of these, and we're not necessarily defining strategy here at the moment, but regardless of what one strategy is, talk about the emotional buy-in. If there's no real emotional buy-in, success is just never going to happen, is it?
Well, it's a very good point, and the emotional buy-in occurs because the trading approach or the investment approach is genuinely yours. You have researched it. You have thought about it. It springs from your creativity. It springs from your work. And it's the time and effort generated that generates the strategy that helps you understand it and believe in it. That's why it is perilous to borrow trading strategies from others, because at the end of the day, you're really not trading your strategy, and it's unlikely you will have the conviction to stay in that strategy during those inevitable periods of drawdown.
Well, of course, you're talking to a guy that wrote a little book on the turtles, and I think some of them would say it's nice to have a head start. And I think it's kind of it's a multifaceted point, really, which is if you take a strategy, if somebody gives you a strategy and you don't understand it, and you're just going to follow it like a black box and just trust the signal that comes out, that's death. You're not going to make it. However, we all have to learn from somebody. We have to start somewhere. So if you can get a head start, if you can move down the path, as long as you understand what's going on, of course, that's how we all learn. So it's kind of a several layers there to that topic, huh?
Yeah, I love that point, and it's really about mentorship, and I see a lot of good mentoring at the firms where I work. You're right, in the very beginning, when you have a junior trader who is working at the side of a senior trader, it starts with a head start. It starts with the junior trader mimicking the trading of the more senior trader. And just like in the old days, the beginning painters mimicking the brushstrokes of the masters. That's what mentoring is all about in the earliest phases. And it is a head start, as you point out. It's over time, as people make their own unique observations of markets and adapt their trading to their strengths, they start to develop their own style and begin to express that approach to trading in their own manner. To take the example we've been talking about, someone may learn at the feet of the master trend following, and over time may implement it in new and different markets, may implement it on different time frames, may implement it on relative price movement rather than absolute. There would be many ways to make the strategy one's own over time and develop that conviction that helps people stay in the strategy once it's theirs.
Let's talk about the notion of a checklist and ultimately moving that towards a flow chart. Something concrete. I mean, it's a standard operating procedure. I mean, really, and if people are listening to you, I asked you the question about personality. Your personality as you talk is your work. I mean, anybody with a pulse would read your book and then listen to this podcast and they'd be like, okay, those are both Brett. Those are both Brett. I mean, there's you just know we're dealing with the same person. As my mother had read my books and she said, okay, that's you. I can tell that's you. But talk about the notion of a checklist, because in your personality, that I have a feeling just is simpatico. It's natural for you. It might not be so natural for other people. Or am I wrong? Was it natural for you, the checklist?
No, I wouldn't say it was natural, and I think that for me it was part of an evolution. I think that's true for many people. When Atul Gawande wrote the book, The Checklist Manifesto, he wrote it, I think, because he saw that checklists were not standard operating procedure for most people, and yet they worked remarkably well for airline pilots, for surgeons, and so forth. And so the idea of a checklist is to figure out those best practices. What are you supposed to be doing when you perform well? And you codify that in a list. And you don't perform, you don't risk your capital unless you do A, B, C, D, and E. Over time, you may discover new and different best practices, and so your checklist will evolve. But it's a way of grounding yourself so that, once again, those best practices turn into habit patterns. They turn into processes.
Brad, how many traders do you get that come across you for the first time? Maybe they've engaged you, maybe it's just casual conversation, and they've got so much excitement. And maybe that excitement is an unbridled excitement. It's not necessarily focused. They're focused on the outcome. Your personality probably does a very good job of calming people down. And if they can't calm down and take it to a checklist type scenario, it's probably a pretty good self-reflection of saying, hey, you know what? Maybe this isn't for me.
Yes. And again, a good point. Many people are trading implicitly for action, for thrills, there's nothing worse for them than a quiet market. That approach to trading really rubs against the grain of being more process focused and keeping checklists. So that I like people to be passionate about what they do. I like them to be excited about their work and about what they discover and what they trade in markets. But ultimately, you want them doing what works best. A great example in baseball history, of course, that you know about is Ted Williams and how he diagrammed the strike zone and determined his batting average for every possible location of a pitch, so that he knew where a pitch would have to appear on the plate for him to have the best odds of getting a hit. That's what people do when they develop best practices and checklists. They figure out what they do best, and they turn that into a set of routines.
Brett, I have one more thing I wanted to bring up with you today. I forgot to bring it up earlier. It's not really intertwined in our conversation. It's more on the outside, but I think, frankly, once one understands it, it's on the inside. And that's the notion of fitness. And I'm talking about physical fitness. I think we can all think back to some article we read in our youth, or we saw a picture. Maybe there was a trader or a very successful person, and they just carried in their public pictures an appearance that was clearly not healthy. And sometimes I think maybe even as a young man, I would say, okay, well, I keep myself healthy, but you might be thinking, well, it's not important. And I think overall, though, that even if you can think to the example of somebody, that guy, he made hundreds of millions of dollars and he's really overweight and doesn't care about fitness, that's the wrong connection. That's the wrong way to look at it. Why don't you talk about health and fitness and perhaps even add in a little bit of your views on yoga and the moment of now?
Great questions. The research in psychology tells us that a positive emotional experience is associated with superior processing of information. It's associated with superior productivity. It's associated with superior creativity. Maximizing our positive experience in general is a way of preparing ourselves for trading performance. Part of that is our physical preparation, our energy level. Eating is part of that. Sleeping well is part of that. Physical exercise is part of that. Using yoga or meditation to help increase our focus and to help us stay calmly focused is part of that. the training that we do on the physical side, on the personal side, ends up fueling positive emotional experience, and that ends up giving us greater focus, concentration, energy level in our trading. I would say the same thing, not only of exercise, but of the quality of our personal relationships. That maximizing our positive experience from those ultimately fuels our energy level, and that ultimately fuels our trading.
Brad, it's cool stuff. We could talk forever. I could just sit here and pick up ideas and pick up questions, and we could just keep going. The book is out. Where can we send people? Where's the best place we can send people to check you out and your assorted books? All highly recommended. If you've not bought them, then you know there's something wrong with you.
Well, the nice thing is plenty of stuff online for people to check out, and they can decide if
you've given so much stuff for free away over the years. I mean, checking out your blog and stuff, that's a wealth of information. So,
well, thank you. Yeah, that's really where it starts, is with the Trader Feed blog. That's Trader Feed, all one word, TraderFeed.blogspot.com. I post to that daily. And then I'm writing a blog also most recently for Forbes. You could check out by Googling Forbes, Brett Steenbarger. And then, of course, the most recent book that I alluded to earlier, Trading Psychology 2.0, is available at a discounted price on Amazon, and really puts together, I think for the first time, puts together positive psychology research, recent psychology research, and what that specifically means for trading performance. That's what got me excited about that book. That might be worth checking out.
Even though it's about trading, I mean, we could really take out the phrase trading, and your work could apply to just about any discipline.
I think that's very, very true. You know, trading happens to be the playing field that I've chosen and others have chosen. But in fact, the principles of performance are common across disciplines. Ultimately, we pursue the disciplines that speak to us.
Brett, hopefully you will come on again in the future and educate my audience, educate me. I think my blood pressure goes down just talking to you. I can't get as excited as I normally might be.
I wish it was that way for my kids.
Brett, thank you. Take care.
Okay, thanks so much, Mike. Great stuff.
Next, let's get in with Jason Williams. The reason this conversation came to be, well, it should have come to be based on a conversation that I had with your father in Beijing in June, because we were talking this type of content, the mental edge trading, but somehow or another it escaped my mind. There was somebody else. I did a casting call for guests, and like several other random people in my life were like, hey, you need to talk to Jason Williams. And even then, I don't think I connected the dots. And I was like, oh, you know what? I think this is what Larry was telling me. So it took me only many months to figure out and piece together. And I must say, for those people, and this is kind of a side conversation, because everything we're going to talk about today is kind of standalone work in your world. It just so happens that you're the son of Larry Williams. But what's really interesting for me, having only met Larry that one time in Beijing in June, what a magnificent street magician that man is.
Yeah, well, if you have to see the same tricks over and over for your whole lifetime, it's still nice. I enjoy the showmanship and the reaction and how much he enjoys doing it. But my role is to really sort of try to catch him in his tricks and see where he's slipping up, so when he goes before a new audience, he can perform well. So I actually prefer that role. I like to try to find out how the tricks are done and to purposely slip him up or throw a monkey wrench into his trick. So that's my role. But yes, I think if he had his choice, he would be a professional magician.
It's interesting you say that you try to trip him up. Figuratively, in some ways, I look at your work that we're going to talk about today, the mental edge in trading. I look at it in many ways that you were looking at your father, a successful trader, and then decomposing, breaking down, deconstructing the parts, what was going on the mental side. Why don't you talk about how you give a little bit of your background in terms of your medical training, but how did you start to have this inspiration or this direction to go with this particular work and this all the research you've done?
Yeah, well, it would not have gone in this direction if it wasn't my father who asked about this whole topic, and it just kind of started things off. But, my medical career was a second career. I used to be kind of a business guy living and working out of China, actually, for over a decade. I was involved with pharmaceutical research and import and export with China and developing different types of vaccines and such. And it got me more interested in medicine. So I had a career change where I went off into medical school. I impulsively went off to, there's a good psychological word. I impulsively decided to go to medical school one day without any sort of prior conception of that might ever happen. And then as I was going through medical school and just, looking at all the various organs and the systems in the body, I just fell in love with the brain and how it works and, the emotions and the behaviors and the thoughts of individuals and how everyone's unique. And yet there are a lot of common themes as well and how to help people. I just fell in love with psychiatry. It was a no-brainer, no pun intended, that I would go into psychiatry instead of studying the kidneys or the heart or something like that.
I can offer for the audience out there, and I hope this doesn't scare the audience, but the mental edge in trading, your first work, this is not light reading. This is dense. There's some density here, yes?
Well, not only density, but let's also throw in scientific validity too, because I went to I completed my medical school education at George Washington and went on to do my psychiatry training at Johns Hopkins, which happens to be one of not only the top psychiatry programs in the country, but they are very rigorous when it comes to the psychological training of psychiatrists as well. Unlike a lot of other training programs, they actually train their psychiatrists in doing personality testing and helping. And that's something that a lot of psychiatrists don't do. A lot of times that's more in the psychological realm. But it just happens to be that the person who invented, the co-inventor of the most scientifically validated and rigorous personality inventory or test is at Hopkins, and he trained me. And so it just, fortuitously, that led to from one thing to the next. And so it was actually during residency training, after having learned about the personality traits and how to test people, not with Myers-Briggs and those kind of psychobabble tests, but actual real scientific tests. It was after learning that my dad just happened to ask me one day, "Hey, what do you think makes a great trader?" And he really initiated the actual body of work. It was that question. It was not something that was on my mind. I probably never would have, if I didn't have, Larry Williams to be my father, I probably never would have, be talking to you here, obviously. And so, just one thing leads to another. And it actually went, as I was still in residency, I started working on a research project. Every resident needs to have I was involved with multiple research projects, but this was sort of my senior year research project as a resident at Hopkins, was actually giving the standardized personality inventory to a group of very successful, long-term successful traders, not just people who necessarily manage money or oversee money, but actual traders, and see if there were any common themes or what we could find out from them. It went from sort of a question that my dad had to a research project in residency, and then as we got more and more interesting results, we started talking and writing about it, and pretty soon McGraw-Hill got interested in what we were doing, and they asked me to do a book on it. So we put everything into a book, and it's led, one thing leads to another. I've given presentations at the MTA in New York and in Tokyo and Seattle, and online seminars all over the world. And I actually, with no intention of doing it, have sort of built up a little side business of consulting traders all over the world about how to adapt their personality traits to a trading methodology that's more effective for them.
I'm going to break apart some basic issues, work our way forward to the personality research and some personality understanding and education you can pass along to the audience. One thing I would like to add, because I think you just made an interesting comment. I am a guy,
obviously I have, well, not obviously, but I have no training, no academic training. But many, many moons ago, a young lady convinced me to go sit through a couple days of learning how to administer the Myers-Briggs instrument. I never really got too much out of it, but I did feel like the understanding of things like extroversion, introversion, and sensing, intuition, thinking, feeling, judging, perceiving, I thought these were useful. But you're the guy that's got the severe education in this field. Why don't you pick the Myers-Briggs apart for a second?
Let's start with some of the research. So when people have given the Myers-Briggs to individuals, and then they re-give it a second time, even just weeks later, 50% of the time the results are different. All right? And so that kind of shows you that there's no validity to it. 50% of the time the results are different, which is very unlike the personality tests that we use in our research and the researchers use, which are consistent not only weeks, but over years and decades and throughout a lifetime, that the results stay the same. So the Myers-Briggs, have you ever heard of the Fourier effect by any chance?
No, explain it.
Sure. The Fourier effect is sometimes referred to as the Barnum effect, as in P.T. Barnum, and it's an effect that's used by astrologists and psychics, where if you give anybody sort of vague information about themselves, they will generally tend to agree with it, and that's what generally, for the most part, that's what the Myers-Briggs does. There's only one of the traits on the Myers-Briggs, and that's the extroversion trait, that is actually scientifically validated. The rest of them are not validated, and they're all positive. It's a test that is used a lot by human resources departments of companies, because it generally gives a glowing distinction to people who take it. There are no negative connotations in the questions that are asked on it, and so it's used to sort of bolster people's confidence in themselves more often than really understanding their personality. So Fourier was actually a psychologist back in the 1940s who actually, what he did is he gave a bunch of people a personality test, and then he gave everybody the same identical results, and everybody seemed to agree that, yeah, this really describes me to a T. But what he really did was just pull out some random information from an astrology book he bought at a newsstand, gave everybody the same results, and everybody said, yeah, this test is great. And so that's largely actually what the Myers-Briggs does. And what many people don't know is it's a little bit, I don't want to, I don't want to use the word scam, but one of the board members of the company that runs that test, actually in an interview with the Washington Post, he himself said he would never use that test in his own research because his colleagues would laugh at him if he did. So it's just not the test that people use. It's also a binary test, and this is something really critical I hope that your listeners will get from this, is binary means yes or no. And so you're either an extrovert or an introvert. It doesn't look at things any more detailed than that. And the reality is that something like extroversion, everything is on an extreme, but everything is on a spectrum. To one degree or another, or maybe to an extreme, somebody may be an extrovert or an introvert, but some people are in the middle. The best analogy that I can use to dimensional personality traits like extroversion would be to look at something we're more used to thinking about, like human height. If you look at everybody across the world and measure their height, you'll get a bell-shaped curve of tall people, short people, and most people are kind of in the middle part of the curve. And really, you really want to look at the people who are at the extremes of the bell-shaped curve, because that's where you either run into problems or where it can really be to your advantage as well. And so let's look at a couple sports figures. Think of like Yao Ming, the Chinese basketball player, and Victor Espinoza, the jockey who won the Triple Crown earlier this year. So, right, their heights are very different. Yao Ming, built to be a basketball player. Victor Espinoza, built to be a jockey. And if they tried to reverse their jobs, it would not work well. And so those people just happen to realize that their physical attributes adapted to a certain thing. Same thing goes with personality traits. So it's not just a matter of whether you're tall or short, but how tall are you and how short are you? And more importantly, if you're short and you're trying to, adapt to life circumstances like Well, let's say your favorite brand of peanut butter is on the top shelf and you can't reach it at the supermarket. Like, how do you adapt to that? What do you do to compensate? Are you going to buy some elevator shoes or whatever the issue, whatever the solution may be? So that's kind of the analogy with personality traits as well, and that the Myers-Briggs doesn't even look at. It just says you're introverted or extroverted, or you're tall or you're short, and it doesn't give you any kind of a measurement to compare you to the rest of society. And that's what the NEO, which is the abbreviated name of the test that we use in our research, that's what it specifically does. And it's been demonstrated to be valid across all countries and socioeconomic populations around the world. It's been translated in all kinds of languages and verified, and it's got more research behind it than I would ever care to even read, because you could spend a lifetime.
Before you even go into the NEO, and since I've opened up personality here, we're going to go down this path for right now. We'll circle back on some issues. Let's talk about personality for a moment, because, okay, we're going to learn in our conversation today, the audience is going to learn there is a very scientific way, as you just mentioned, that one can evaluate a personality, determine a certain type of personality. Talk big picture for a moment. Okay, so once we know our personality, and like I said, in a minute here, I want you to break apart the NEO, but once we know our personality, then what? Ultimately, the mental edge in trading, so the audience is probably already thinking, okay, once I know my personality, then what? Is there a bad personality? Is there a good personality? Or is it a matter of, once we know our personality, it's a matter of making the proper adjustments if we need to, as opposed to saying, okay, I scored on the test that Jason's talking about, the NEO, and my personality is this. That means I can't do something. It's not that, right?
Right, it's not that. And there is no such thing as a bad personality or a wrong personality. There are different personalities, and everybody obviously, well, I know some people who don't have any personality, actually, Mike. But for the most part, everybody has a personality, and everybody is unique. That was a joke. It is about understanding. So when I first took this test, there was one personality trait on it that I vehemently disagreed about. I complained to the person who wrote this test and has written all kinds of research papers, and I said, this is not true. The test showed that I was an impulsive person. And I said, no, I pride myself in being somebody who's not impulsive, and this is wrong. Your test is wrong. It's missing something. It's not really understanding me. And he said, no, I'm the one who's wrong. And he literally threw a large stack of research papers on the table in front of me, and it went thud. And he said, read all this, then come back to me and talk to me about it. And instead of reading all that, I did something else. And that was, I kept more of an open eye and ear to myself to see if I was impulsive and where and how I was impulsive. And over the years since I've taken that test, and also looking back at other times in my life, like impulsively going off to medical school and things like that, I realized, hey, I am a lot more impulsive than other people. I didn't recognize it. So sometimes this test, for a lot of people, this test there are no eye-opening shockers. For a lot of people, it's yeah, I kind of knew that I was this and that, but it shows them a relative degree. For other people, there really are some aha surprise moments, and sometimes that surprise moment's not when they look at the results, but only after a little bit of time to really think and talk to other people and reflect, people who know them, and then they realize hey, yeah, this is a problem. I never noticed it. So just an awareness, first of all, is the most important thing. And there, a lot of times people say, hey, I have a bad personality, or they get their results in the mail and they're so embarrassed. They paid for an hour consultation with me and they never even want to talk about it because they're so embarrassed. And I feel bad, because it's not a matter of embarrassment. It's not a matter of right or wrong. So evolutionary psychology, which is sort of a discipline, says that these personality traits over the centuries and millennia, that they are stable, and that there's a reversion to the mean. It's a statistical term, but revision towards the mean. But that most people are in the middle with these personality traits, and some people are at the extremes. And those extremes can get you in trouble, or they can be like Yao Ming, super tall, slam dunk millions of times and make millions of dollars in the NBA. The problem is, you're Yao Ming, you go to the mall, you might have like money flowing out of your pockets, but you're going to have to duck every time you walk through a doorway, and you can't buy a suit that fits you easily. And even if you're in first class on an airplane, you're pretty cramped. So, it's more of an understanding, like, what are my traits, personality traits? Where am I on the dimension? Which are the ones that are really surprising to me? And how can I use this to my advantage, not just in trading, but in life in general, relationships, work, all sorts of things. How can I use them to my advantage, and how are they getting in the way? And so that's where you go next once you understand really where you fall on these dimensions. So,
Jason, let's break this apart specifically for people. So the NEO, it's a 5-factor model as you described. Why don't you break down those 5 factors in brief, describe the main term and what each means in context for the audience?
Sure. So they're referred to as the big 5 sometimes, but then sometimes they're broken down to the big 3, and that's where the term NEO comes from, N-E-O. But really, if you look at the big 5, it would be N-E-O, A, and C. Neuroticism is the N, extroversion is the E, O is for openness, A is for agreeableness, and conscientiousness is the C. Neuroticism is not like what somebody would think of Woody Allen as always being just a little jittery and neurotic. That's not what researchers and scientists mean by neuroticism. Somebody can be stone cold, cool, calm, under normal circumstances, and then something challenges them or provokes them, and all of a sudden negative emotions come out fast and furiously. That's neuroticism. Like somebody who gets into a minor fender bender on the road, right before the fender bender, they may have been perfectly calm, but as soon as there's a little incident or something happens that was unexpected, they may fly into a rage or become depressed or anxious or have some sort of negative emotion that just flares up really fast and furiously. That's neuroticism.
But this is on a scale, so we're all a little neurotic to some degree or another, right?
Everybody is neurotic to some degree or another. Some people are, we all have, so neuroticism is just we all have the same emotions, and including all the negative emotions. So neuroticism is looking at how one tends to experience, how quickly and strongly one experiences negative emotions. So we all have anger, fear, sadness, those kinds of negative emotions, depression, those kinds of vulnerability, those kind of negative emotions everyone has. Is just to what degree are you on the low end of the spectrum, and which is not necessarily a good thing, right? You don't want to necessarily be too low. I'm not talking about trading right now, by the way. We'll come back to the results when we get to traders. Things are a little bit different, but just in the general population, in society, in the world, you don't want to be too high or too low. At least according to the laws of evolutionary psychology, that most people that are under the middle part of the bell-shaped curve for a reason, that's advantageous. You want to have some degree of negative emotions so that you're aware when negative circumstances, and so you can get out of the way when there's a lion around the corner and all those kind of fight and flight types of reactions. That if you're too low in those emotions, that it can be problematic. But that if you're too high in negative emotions, that it basically overwhelms, drowns out sort of the logical, rational side to your brain. On a sidebar note here, it's really important for people to understand that the brain is, although you might hear about the left and the right side of the brain, that is not where you want to be spending your time thinking about. Really, the brain is thought of as the outside part of the brain and the inside part of the brain. Those are the two sides of the brain. The outside being the logical, intellectual part, and that's your cortex, and that's the newer or the neocortex. And then the inner part of your brain, or the subcortex, is where all of your emotions and memories and sort of innate responses are. That's the inside part of your brain. When people have high levels of neuroticism, negative emotions, super high ones, it sort of drowns out or overwhelms sort of the logical, rational side of your brain. I'm sure your listeners can already, understand in trading where that kind of comes into play. So, but by and large, you don't want to be on too far of the extreme one way or the other. Although when it comes to trading, we found some interesting results. I'm sure we'll get to that in a little bit. But that's what neuroticism is. Extroversion is not necessarily just, are you the party goer? Are you the life of the party? That's kind of part of extroversion, but there's more to it than that, actually. Extroversion is really whether somebody has an internal or external locus of control, or how much of it. Everybody has some degree of extroversion. No one's a complete island and a total hermit, but it's how quickly you warm up around other people and how much you enjoy being. And it's really do external things stimulate you and make you happy, or do more internal things stimulate and make you happy? And again, it's on a spectrum. Openness is how open you are to new ideas and to trying new things. My dad happens to be like the highest person. He's off the charts with openness, by the way. So that's great because he experiences all kinds of things in life, and he's done all kinds of unimaginable things. But on the other hand, that he's prone to being being open to things that maybe get him in trouble, and he would be the first one to admit to that. And I've had to work with him, and he's really made some strides on that, in understanding that sometimes he's too open. It's gotten him into some all kinds of issues. Agreeableness, the A, is how easily you get along with others, is probably the easiest way to understand it. And then conscientiousness is just how much of a rule follower and how detail oriented you are. So those are your 5 main big traits. Again, those that are scientifically validated across all parts of society, races, genders, etc. Now, it goes a little bit deeper than that, because actually each one of those 5 traits, Mike, has 6 sub-traits. And so, for example, neuroticism, there's N1, N2, N3, N4, N5, and N6, and each one is a different negative emotion. Same thing with the extroversion and the openness and the agreement. Each one has 6, so if you add them up, there are 30 total. What that means is you might be low in some parts of neuroticism and high in others, and maybe sort of normal in others. And same thing with extroversion. And so other personality tests really don't get into that sort of depth as this one does. They just look at the broad brushstrokes. This personality test actually breaks them down into the sub-traits, or facets as they're referred to usually, and looks at sort of the individual components of the 5 main personality traits.
What's the process? I can remember, as you've already laid out pretty clearly for the audience, that they should not be running around their office environment wearing their 4-letter score on their heart from the Myers-Briggs instrument, like that somehow there is defining them for the rest of their life, which is commonly done in a lot of places. But why don't you talk about the process of this NEO test? Is it just a Q&A type thing? What is how do you get the result? How does that work?
Yeah, so it's a test that is owned by a company, so it's not something, it's a very protected test. There are a lot of sort of copycat tests online that try to mimic it, but really have never been validated, so you don't know if you're really getting the right thing. And so you really want to make sure that you're talking specifically about the NEO PIR, and then there should be a little TM for trademark after it. And there are a lot of copycat tests. Some of them are short versions. None of them are validated, and the ones that are used in research. Okay, so just be careful.
Is it a 100-question test, a 200-question test, 3 hours, an hour? How does it work?
Yeah, I'm getting into that. There are actually a couple different versions. There's a short version and the long version. The long version is the one that looks at all the different facets. It only takes about 45, 50 minutes of time for the average person. It's a test where it goes through a number of questions or really statements where you rate whether you strongly agree, or neutral, disagree, or strongly disagree to the statement. Okay, so it's not yes or no. That's where sort of the dimensional part comes from, is that you're not just answering yes I am or no I'm not, but how much. And each one of these questions has been worded in a very specific way. There are a lot of built-in mechanisms to the test to make sure that somebody's either not providing artifactual or false answers, or that there's some test-taking errors as well. So you need to kind of make sure that somebody's taking the test appropriately, and there are built-in checks and balances in the test. So, but the test is available both as an electronic version, not online, but I guess if a psychologist or psychiatrist has a computer station, somebody can take it, or a paper version is available too. I prefer to have my clients take the paper version, and I just send it to them in the mail, and they send it back to me, and I score it and then send them the results. So it's not a painful experience. The questions themselves on the test are pretty irrelevant. like later on, after I've graded the test and I'm talking to the test taker, we don't look at the questions on the test. They're totally irrelevant. The test questions are just sort of provoking answers and getting into the psychology of the person, but they're irrelevant as far as when it comes time to understanding the results and how to apply them. So we basically even trash the questions. That's not the important part.
Talk about your research and working with traders specifically for this test, because I imagine, given your position, that the one thing that you wish you had more and more of were more and more traders to take this. I mean, the more data you have, the more excited you probably are. I mean, that's probably the biggest weakness in your world, I would guess, is you probably wish you could give every trader and go through the results and just get more and more data, right?
That would be nice. And, I have continued to give the test to traders after, the book's been out a couple years now. And so we've, gone on to test more people. But that would be nice if we could test every trader. And in my book, I don't just test them. I also interview these traders and really understand on a deeper level how these personality traits are affecting their trading and what types of things that they do to compensate. So, yes, I would love to test everybody and understand everyone. Obviously not very feasible.
Can I give you an example to let you run with? I'll let you go long form with this example. Ralph Vince. Ralph Vince has been on my show. Ralph Vince is one of the most interesting interviews that I've had. A really interesting guy, and that's probably saying it mildly. Why don't you take as an example, Ralph, talk about everything you want to talk about, whether it's in meeting him, the testing process with him, what you learned, and something you can pass along to the audience that perhaps would be interesting about working with Ralph Vince, a very noted, money management expert on top of expert.
Yeah, we'll do that. And I don't have actually his test in front of me. And in my book, he agreed for me to use his name and give some general understanding of his personality. But these traders didn't want like everything divulged, so there will be some limitations to that. But let me back up a second and just kind of talk about one more thing before we get to Ralph, and then we can use him as an example. So, have you heard of Andrew Lo before?
Yes, MIT professor.
Right. He's a professor at MIT. He's done a lot of research on trading and many different aspects, and very brilliant guy. He actually started looking into this 10 years ago, back in 2005. One thing that he did, he gave the short version of this personality test to a group of traders, and he only had 80 traders in his little group. And then he also measured their performance over about a month period of time. So that's what Andrew did in his test. Now, there were some drawbacks to his. He only had 80 traders. He was only looking at their trading performance over a month. And as everybody knows, anybody can have a bad month or a good month. And that doesn't necessarily mean that they are good long-term traders. And the other thing is he used the short version of the personality test. It doesn't break it down into separate facets. All right, like I was saying, the N1, N2, N3, and so he only was looking at the big 5 traits, N, E, O, A, and C. And what he found in his research is that there was no correlation between any of the big 5 personality traits, at least for that 1 month, successful market trading. All right, and so that was kind of like the only person who looked at this idea with any really scientific mind behind it. What we did is we took a group, dozens of very successful traders who have been basically people my father has known for a long period of time, been successful traders over decades, and we gave them the full version test to see if we could break things out a little bit. And that's where things got interesting. And what we found, again, before we get into Ralph in a second, is we found that one of the most consistent themes in the test was almost everybody was low in trait anxiety, which is the first neuroticism trait, as we were talking about before. Whereas some of the other neuroticism traits, like anger and depression and self-consciousness and impulsivity and vulnerability, those are the other ones, they were not necessarily high or low. Somebody could be high in one and low in the other, or middle in the other. That didn't seem to be so much of an issue as being low in the N1 trait. So in Ralph's case, what really stood out in his personality results is that he's really high in N2, which is the anger facet of neuroticism. I don't have his results in front of me. I wasn't necessarily prepared to talk specifically about Ralph, but I remember that was sort of, the main thing that stood out with him is the anger and him working and finding ways to manage anger in trading, and not just specifically trading, but in other aspects of his life. A lot of the times, it's not like one's trading life is removed from all the other aspects of one's life, relationships and other responsibilities, and paying for college, tuition for kids, and all these other things are going on simultaneously. In his case, and in other cases, there were certain traits that were getting in the way, perhaps at times, or at times they were able to find ways to overcome them. But what was most interesting was that consistently, N1, anxiety, low.
Talk about that a little bit more, though. Anxiety low, which just, essentially like, okay, the daily market activity is hitting you. And whereas some people might get all geared up and they're flipping on CNBC, they've got the adrenaline pumping. I don't know, they're screaming at the dog. I think what you're really saying here is the traders you worked with, none of that stuff, they don't care about that.
Yeah, well, I wouldn't go quite that far. I think that, every trader experiences anxiety. Real money is involved. There is anxiety. Every single trader I've talked to said, including very successful traders with very low anxiety scores, that doesn't mean they don't have any anxiety. It just means that their anxiety levels are not going to be so profoundly strong that they get in the way with the logical side of executing trades. Again, thinking about the outside part of the brain and the inside part of the brain. They still have anxiety. And in fact, what most of these traders told me, successful traders, is that it's important to have a certain amount or degree of anxiety. All right? Just not too much. And that anxiety is really a two-edged sword, because, the market, depending, I guess, on your beliefs into, what makes the markets move and tick. If you believe that there are trends in the markets and that the trends are being caused by, investor, emotions and beliefs and all that, behavioral finance, which most people are, pretty much recognizing at this point, you need to be able to be in tune with the emotional cycles of the markets. So it's important to be able to tune into your emotions and know when you're feeling anxious in the markets, and to register and correlate it to the emotions of the other traders in the market and the trends in the market, but not to have the anxiety be so overwhelming that it prevents you from executing really what is logically the right thing to do in the market. So it's in one degree, anxiety is important to have to a certain level. Jerry Rice, I grew up in Northern California, a big 49ers fan. Jerry Rice, as a football player, talked a lot about anxiety and fear. And I don't have the quote in front of me, but one of his great quotes that he gave when he was inducted into the NFL Hall of Fame was, he said, a lot of these sports psychologists tell you that you need to eliminate anxiety. And Jerry Rice said, no, that's not the goal at all. That's not, at least for him, that's not how he got to be perhaps the greatest wide receiver in the NFL. He said, you need to have a degree of anxiety. That's what pushes you on. It helps you sort of monitor. It's a barometer of what's going on in the game or in the market. So you need a certain degree of it, but you want a very low level of it so it's not overwhelming. So I think that's what the research is telling us, Mike.
You brought up behavioral finance. I would love for some perspective from you, and let me outline where I would love for you to comment on. I look at the work of Daniel Kahneman, Vernon Smith, two gentlemen that have been kind enough to come onto this podcast, guys that have, Kahneman even more well-known than Vernon Smith. And they did this fantastic research, this fantastic work. I look at some of the systems traders going back into the 70s, Richard Donchian into the 50s. And I look at some of these systems traders and I think to myself, they didn't get credit for figuring out the behavioral finance, but they actually have the results and the trading that was backing the notion of behavioral finance long before the well-known academics got the awards. I think sometimes
the Nobel Prizes, right?
Right, exactly. I sometimes think that some of the traders have really gotten a short stick here in terms of recognition as to, especially the systems traders, because the systems traders, so much of what they do, it's just their whole entire way of being is almost, to me, like a one-to-one relationship with the very issues that Daniel Kahneman would write about in Thinking Fast and Thinking Slow.
Yes, and if anybody hasn't read his books, I highly recommend them. I'm actually going to be coming out with a book shortly that goes into behavioral finance and cognitive biases, and more specifically, how to manage cognitive biases in trading the markets, and how certain personality traits are connected to certain cognitive biases. It's for decades. There's been dispute about that. I'm not a professional trader by any sense of, and I'm not an expert, okay? But I'm very fascinated in the history of finance and people who look at the markets, and it's fascinating. It's like there's great meaning, I think, in the markets, and there's been a debate about that very topic, whether or not there's meaning in the markets for a long period of time. You've heard about the random walk down Wall Street. Even before that work, back in the 70s, there were people back in the 40s and 50s who were asserting that that there's no meaning, or there are no trends, that every price is completely independent from one another, and there's no way to make any sense of the movements in the market. That's one philosophy. Then there have been a number of people who've taken quite the opposite approach. Andrew Lowe actually has done some of the most exciting, mathematically significant research showing that the random walk theory is wrong, that there are statistically things that you can see and trends that you can see. He's looked at it from a very statistical, mathematical look. A lot of people sort of have theories and develop trends or models or systems, but to actually mathematically prove it that it's not a random walk. That whole topic is just fascinating to me. But yes, there are a lot of I would put my dad in that category, and this will kind of segue into another topic that I'd love to talk about. But my dad is known for developing some trading systems and trading indicators, but specifically he's thought of as a systems trader, right? But the interesting thing, and he only realized this after he took this personality test, is that he was great at developing systems, but he was horrible at actually trading the systems.
Talk about that a little bit more.
Yeah, and so one of the big 5 personality traits is conscientiousness. All right, and what we found by researching these traders is that traders can be high in conscientiousness and low in conscientiousness, or somewhere in the middle. And that when you sort of look at their trading styles, they break out into 2 distinct camps. You have more systems, rules-based traders, and then you have people who are more discretionary traders. But what's fascinating is that there's a personality, one of the conscientiousness facets, which is the C2 facet, actually predicts which trader is going to be successful at trading in a systems way and which one in a discretionary way. And what my hypothesis is that these successful traders that I've looked at were able to figure that out over time. Most of them probably never had even thought about, what is my personality and how do I match it up with the right trading system. It may have been just a trial and error process where they were able to adapt a trading strategy to their personality. But there are probably a lot of people out there who are struggling with one form of trading and not realizing, hey, maybe that's not, the methodology they should be using. I actually brings to mind a very specific trader that I've been working with who for decades consistently was losing money. He might have a one good trade, and that would kind of give him a little bit of confidence, and then he would have a number of losers, and year in and year out he was losing money, but he wasn't not making any changes to the markets he was trading, how he was trading them, how he was managing his money. He was doing the same thing over and over. We all know Einstein's famous quote about the definition of insanity. But what I think really this personality test does is it really makes explicit sort of some implicit things that we know, but we don't always sort of recognize and really address in our lives. And that's where this test is really helpful, and where the results in the book are really helpful as well. So my dad, it turns out that his C2 score is on the low side. He may have, he has a very, high intellect, and he's very good at developing systems and, using computers. But when it comes to actually following the rules of his systems and sticking to them, he could not do it. And whenever he tried, he would lose money doing it. And other people were able to take his systems and make money doing it. And what he developed over the years, and years ago, what he developed was, the idea that, hey, he better not trade his own systems, but have somebody else trade for him. Now he just uses cloud trading, and he's not involved. But that's where he had to sort of make an adaptation to make sure that he wasn't getting burned in the market simply because he was, not fit for actually systems trading itself. He's great at designing and developing systems. It's the sticking to it and not breaking away from his own rules that's where he was struggling with.
Now, Jason, let me ask, was that a result of you working with him? And I'm going to use a little terminology from your book. Was that a result of some cognitive behavioral therapy?
Yes. Cognitive behavioral therapy, I would never claim to be treating my father, because that's unethical. It would be unethical to treat my father or use cognitive behavioral therapy, but the principles of cognitive behavioral therapy are highly effective for managing somebody's anxiety or changing their behaviors when it comes to their trading. Those are exactly the principles we use.
Once one takes the personality test, the NEO, that if there are, and this is my terminology, perhaps you can have different terminology, if there are imbalances, there are ways to get people to think about ways to, perhaps if they're too extreme on the scale, to reel themselves in a little. Would that be a good way to look at it?
Yeah, there are, but it's not a one size fits all. For some people, cognitive behavioral therapy is the way to go. Other people are really much more responsive to, relaxation and, visualization techniques are more helpful for people who are very high in like a trait fantasy and aesthetics, which are two of the openest traits. Those people, I use very different methods to help them than I do with people who primarily are dealing with anxiety, really need just basic cognitive behavioral. Some of the basics of cognitive behavioral are, number one, is you do not want to, when you have something that is fearful, something that's causing anxiety, you do not want to flee from it, because all that does is train your brain that fear was legitimate when it may not have been at all, and that the same anxiety is going to come back the next time you are in the same sort of situation. So that's where something like stop losses comes into play. I recently had a trading coach, I can't use his name, but a trading coach contacted recently. He said, "Hey, Jason, I've got 3, I think it was maybe 4 traders that he was really struggling with. And this is a well-known trading coach. And he said, I'm struggling. I'd like them to take the personality test and see what's going on." So it turned out one of these traders that had really bad anxiety, and he was getting into the classic problems that high anxiety causes in trading, where somebody might be in a good trade, but then they just, a little turn in the market, even though they know better, they exit the trade, and a big winner turns into a small winner very quickly. That's a classic thing, a little anxiety, and you freak out and you exit, and later on you regret it because actually you knew better. So, but it turned out this trader who had been working with this trading coach for years, maybe even decades, trying to figure out why he could not, it turned out this trader had sort of lied to his trading coach and said, "Hey, I'm using stop losses," when actually he hadn't been all along. And the trading coach was astounded that his pupil had been actually lying or misconstruing how he was trading. And so the use of trading stops is huge when it comes to managing anxiety, because again, the whole principle is, like, if you have a dog phobia and you're walking down the sidewalk you don't want to flee to the other side of the road, to the other sidewalk, because that's just going to reinforce in your brain that all dogs are scary, all dogs are dangerous. You need to kind of confront the anxiety, and then the anxiety will eventually subside the more you do that. It's simply called exposure response prevention. And that's part of cognitive behavioral therapy. We use it with dog phobias. I use it with traders in the markets as well.
Jason, you've been kind enough to give me your time here on a Sunday morning. As I think about the book, the title, The Mental Edge in Trading, it's on Amazon everywhere. People can find it very quickly. Would it be fair for me to think of your work as the mental edge in trading, in life, in relationships, in work, in friendship, in entrepreneurship? It's not just the mental edge in trading in your work, is it?
No, it's really not. And again, I'm not necessarily a trader. I'm a psychiatrist. I'm a physician. It just happens that because my dad is who he is, that this kind of came to life in this manner. But really, all of these lessons, and you know what, Mike? That's what life is about. It's about understanding yourself. When you make a mistake, understand why you made that mistake and how it came to be, and how you can adapt to both your positive physical and psychological traits, and also the negative ones as well, so that you can have a healthy and prosperous life. That's what, sort of maturing and growing up is ultimately all about, is understanding who you are, your place in the world, and adjusting to it in a healthy way. So yes, it's very much, but that's what I think, that the whole arena of trading in the markets is a really fascinating area to look at, specifically because there's so much emotions involved. And it also is, the markets are very complex as well, as far as understanding them. Nobody really understands how and why the markets move all the time, obviously. And the emotions play such a huge role. It's a great sort of arena to really understand human psychology. I think that people who trade the markets with just the idea that it's all about numbers, they're really losing out on really learning from the markets more about themselves and how to relate to other people. I think then, and I would encourage people to read the next book when it comes out. I think, I get into that a lot more, and that's where I've gained insight. I worked for my dad back in the early 1990s for a couple of years, and I saw his work as all numbers and blips on a computer screen. And I was bored to death, and I left. I didn't want to work for my dad at that point. It looked like a horrible lifestyle to just be looking at numbers on the screen going up and down, and plots of lines and here and there. But now, with this work that my dad and I have been sharing and working on together, he has a better appreciation of who I am and what I do in my profession, and I have a better understanding of not only what he does, but why it's important to him, and how the markets. He's not doing it just to make money or just to watch numbers on a screen. It brings meaning to his life. It helps him understand himself more. And I think that this personality test, brought it to the next level for him. And I think it can for pretty much any trader. That's where this is all so fascinating.
Jason, as I said, the book is everywhere, easily found. The Mental Edge in Trading. Adapt your personality traits and control your emotions to make smarter investments. Where can people reach you? If they love this conversation and they want to reach out to you, is there a place they can find you? Is it a website or an email address? What's the best way to reach you?
Yeah, no website. I don't market this really. This is just more of a project and that I work on the side. My main gig is working as a psychiatrist in a psychiatric hospital. But I do have an email address. That's the best way. If anybody has any questions, more than happy to answer them. Or if they want to even take the test, I can give them information on how to do that as well. But the best way to reach me is just by email, and it's emaildrj@yahoo, and that's spelled out, EMAIL, and then the word doctor is also spelled out, DOCTOR, and then just the letter J, emaildrj@yahoo.com.
Jason, thank you for taking some time today.
Absolutely, Mike. It's been a pleasure.
Coming up next is Van Tharp, and this is not Van's only episode on this show. So please enjoy this particular episode with Van, but go find his other episodes on my podcast. In 2013, they awarded the Nobel Prize to Eugene Fama and Robert Shiller, which
at first blush seems contradictory, maybe even several years later seems contradictory. How did you feel about that when you, I think I know somewhere where you're going to go, but how did you feel when you have the one leader of the efficient market camp and then you have a behavioralist? How did you feel when that was announced?
I think those guys do what they're going to do. I have a long-standing theory on what happens to Nobel Prizes, which is that Nobel Prize in economics is awarded to the person who comes up with some theory that supports the status quo.
Expand.
Which allows people in the market to say, yeah, this is how the market works. So you get anything from efficient portfolio theory to who knows what. It sounds like a good thing. I have all sorts of, I'm not an economist anyway, but I have all sorts of unique things in the market. And you have this great approach that you've been talking about trend following for a long time in a year. But neither one of us will ever win Nobel Prizes in economics because we don't do anything to support the status quo.
That's a great point. I think the way you've just answered that, you don't think much of something like the efficient market theory. I mean, obviously the techniques and the way that you train people, why would anybody show up to learn from you if the efficient market theory was valid?
Yeah, correct. There's nothing to do.
Let me keep pressing you on that, though. So when you hear these things, I think the audience can hear in your voice already, hey, this is just not important. You shouldn't be thinking about it. But I think for as much energy that the status quo does use to propagate things like the efficient market theory, I would love for you to kind of give some thoughts on that, because you've had a chance to be around not only yourself, but a lot of other traders that put that to shame.
All right, I'm going to move this in a slightly different direction, which is I have a workshop now on systems thinking. And the importance of systems thinking is, about 20% of the population can do it. And part of the reason you need to do it is we all have these models of the world which are basically made up. We have no clue about even something like the market, we have no clue what the market really is. So somebody might show you a chart and say, oh, that's the market. And you go, okay. And then you look at the assumptions behind it and you find it's a bar chart and it takes the open, high, low, close of a specific period of time. And if you were to look at the ticks on that, you might find they all distributed around a certain time, and maybe that's all in the top third of the bar, and then there was one tick that was way down, that was the low of the day, or that period, and that was the low. And we've decided, okay, we're going to express all those ticks for that time period as a bar, and say that represents the market for that period of time. And then some people can't accept that, and they say, well, I need a candlestick, or maybe I need a line that goes through the bar, or I need some sort of indicator that tells me what the bar is really doing. In my opinion, all this stuff is made up. Because it's made up, you have to realize that so your map of the market is not the market. It's not the territory at all. You better hope it's useful, which means that the structure of your map is somewhat related to the market, because the more useful it is, the better, more effective you'll be as a trader. But people can make up all sorts of things and then assume it's real. Systems theory, I think, is really important, because systems theory realizes that the map is not the territory, that what we say something isn't that thing, and can shape its thinking around that.
So what does that leave us with?
Well, it leaves us with, I guess it's like my book, The Matrix. It says there's a matrix, it's all made up. If you understand that, then you can figure out what's useful and what's not useful for functioning in the matrix, reprogram yourself to be super efficient, and perhaps one day even go beyond the matrix.
So when I throw that initial question out at you about the Nobel Prize, it's just I'm digging through the disgust in your voice, where it's like, hey, all that stuff is baloney. It's just not important. Don't fixate. Don't stay there. Don't think about it.
It's somebody's beliefs. If you find it useful, great. If there's a way you can profit from it, great. I don't know how I can profit from it. I like to concentrate on useful things.
Let me dig in a little bit here when people approach you. So you have a track record of helping people that goes back decades. You are approached by new traders, I assume all the time, professional traders, people with lots of experience. I'm sure it runs the gamut. When somebody first comes to you that perhaps is a bright person, maybe they're an engineer or a doctor, who knows, or they're just bright, they know what's going on, but they haven't been exposed to something like position sizing. Talk about from your perspective, what it's like to observe people that perhaps, as I said, the bright people, lots of experience, but they come into your world and you start making light bulbs go off for them. It's going to be an interesting thing to watch because many of the topics in your world, very similar to my world, it's still not a natural way, or it's not a way that the system, the status quo, it's not a way for the status quo. It's not the way they typically educate people.
Well, I always say if it were easy to make money in the markets, then big money would make it very hard for you to even participate in the markets. You'd have to go through all sorts of tests and things. But since it's not easy to make money in the markets, they make it easy for you to join. That's what came up when you said that.
For example, your broker doesn't really have to do much due diligence to let you open an account. Really, it's like your name, rank, serial number, and some money, and that's it.
So let me explain what I've been doing over the years, and maybe a different perspective on what it is. So I've been modeling good traders and what they do. So I've modeled the process of trading, which is what we call the tasks of trading. I've modeled how to develop a system that fits you. I've modeled how to position size to meet your objectives. I've modeled what we call the infinite wealth factor. A lot of stuff about market type, because your system has to fit the market type in order for you to be able to make money. If it's market sideways and you're jumping in the market to go long all the time and nothing's happening, you're not going to make money. And if the market's going down and you're trying to go up, go long, you're not going to make money either. So all of those things factor in. When I'm looking at a new person, it's like there's a number of steps. I've got to learn the various models that we've done that work. In terms of, there's a bunch of beliefs that I call think that's in the book Trading Beyond the Matrix that are just useful, and those need to get into your neurology. You need to not just say, oh, I agree with them, but really get them in the point where they're in your muscles and you think, yes, this is the way things are. And you've also got to raise your consciousness enough so that once you know those models, you can actually follow them. And I guess that's our whole process that we do in the Super Trader program, which is making people, raising people's consciousness from, say, fear and greed to at least acceptance, where they can accept profits and accept losses when they come up.
Well, you've condensed that naturally, as you have to in a conversation like this. But let me go back to, for example, some of those stumbling blocks, the new trader. Why don't you speak to, perhaps, pick one or two of the typical biases that a new trader, perhaps a bright individual, walks in with that you need to help reprogram them?
The first thing is that they need to understand that they have to take total responsibility for what happens to them in the markets. It's very easy to think, there's some magic secret to making money in the markets. If you just find that secret, that's it. That's not the case at all. For example, I can give you a really good system. So I could teach you a really good system, and then you start trading it and maybe make 3 mistakes every 10 trades. If you're making 3 mistakes every 10 trades, you're trading at 70% efficiency. And let's say that trading system has an expectancy of 0.8R, which means in 10 trades it's going to make 8R. But let's say that 3 mistakes cost you 2R each time. That means you've taken 8R and turned it into 2R, and that might mean you decide the system's no good, that you can't trade it, all sorts of things. You've got to get to a point where you understand that it's what you do that produces the results, including the mistakes. That's number one. beyond everything. And there's another level of that, which is your responses produce the thoughts you have. Your responses, you give meaning to everything. You give meaning to, if I say a particular word, you basically determine what that word means to you. And my guess is 10 people will hear this podcast and they'll all give a different interpretation to what I say. And you've got to accept responsibility. That's you doing that process. I think that's number one. That's right at the beginning of anything. If I don't have that, I don't have anything.
But when people understand your world, they don't have a different interpretation. It's just those that have not been exposed yet.
Not necessarily true. I could say, think of a dog. What do you picture when I say think of a dog?
My first dog, a big black Labrador.
Right. I was picturing my little Papillons that I have upstairs. Somebody else is picturing a German Shepherd. Somebody else is picturing their dog. Maybe somebody else is picturing the dog that just bit them. They're all giving a different meaning to the same word, dog.
Okay, but if let's say we changed it from dog to position sizing. Yes, there can be different ways that one can go about position sizing, but once everyone has the thrust or the understanding about what the different choices are, that's fairly concrete. Then it really just comes down to your personal risk appetite. So, I mean, I guess what I'm getting at is there are many elements of your world that it's kind of like once you get it, you're inside, you kind of get it. But then for new people, when they're first exposed, they really can have a differing understanding.
Well, sure. I mean, I actually coined the word position sizing because everybody was using the word money management at the time.
Me included.
Money management went from things like, how you manage your finances to, I mean, there were so many different connotations to that it was just off the charts. So I said, well, let's call this position sizing. So it gets down to the factor of how much. And then you look at, the outside world there of investors all think it's asset allocation. And that comes from the kind of studies which say if you look at a portfolio manager or a set of portfolio managers over a number of years, and you look at the variability of the performance, it's a function of how much is in bonds, how much is in cash, and how much is in stock. Well, that's my definition of position sizing. So even asset allocation is what's important becomes position sizing. Yeah, once you make sure people have the same meaning that you do, then you can begin to communicate.
I think there's a little backstory here. Can you give the backstory about how were you exposed, or when were you exposed to the how much question? How did that enter your life for the first time?
I think my second peak performance workshop was with Ed Sekoto. We did a retreat in Hawaii, and I had him present a couple of things. I think he presented the example of a coin flip where you are right, or maybe it was an example where it came up heads 75% of the time and tails 25% of the time, but you wanted what was the most critical factor of that. I don't remember the exact example, but it was something like that. And the question was, what was the most important factor in your trading? Of course, I said, well, it's you. And Ed goes, no, it's how much. I've been thinking about that ever since.
How long ago was that? Been thinking about it ever since?
Late 80s.
Late 80s.
So the late 80s was when we did that workshop together. I was, even before then, I was a turtle interviewee, and I got exposed to Bill Eckart's version of position sizing, which I thought was really genius.
During the interview process, even though you were not selected, you actually gathered that insight.
No, I think there was a question they asked me, which I had no idea what the answer was, and the question was, if the markets are largely random, how can you make money? And I said, I don't have a clue. that stimulated all sorts of things later on about how they do. Well, it's just because it's random doesn't mean you can't set yourself in a position where your reward is twice as big as your risk, or your position sizing is important in that. Yeah. I'm sure those were the answers they wanted at the time, but I didn't have that.
But Ed was that first moment where you had your how much light bulb. That was the first moment with him.
I think so, yeah. My memory is always wrong, so...
It's not just your memory. I believe that'd be all of us, right? Memories are a funny thing. Hey,
memories are sort of made up.
Well, they're definitely not today anymore. They're just a distant past, and who knows if we have it exact. I guess even if you have videotape, it still might be not 100% accurate. Let me ask, though, I brought up Ed Seykota. And of course, that you just this great how much moving into position sizing is such a great lesson for you to be exposed to. Is there anything else? I mean, I've had a chance to spend some time with him and at various points over the years. Is there anything else that struck you or that you really found interesting about your involvement with Ed Seykota? A very open-ended question, which can go in many different ways, and you might have more than one thought.
It was interesting because I think the first time I used him as part of our modeling, we did a video of the interview. The interview was about me asking him questions for about an hour and a half. And when I look back at the video, he didn't blink in the whole hour and a half. I don't know anybody who doesn't blink for the whole hour and a half. But I had somebody watching it later, and that woman said he was channeling something. And I always knew Ed did things like that. That was kind of interesting about him. He dabbled in all sorts of things that were quite different.
Can you elaborate about the channeling and the not blinking, and perhaps from your perspective with a psychological background, the not blinking, is that just intense concentration at play?
No, I think he was channeling somebody who was answering my questions. That's my opinion of what was going on. But Ed, let me put it in a different perspective, because talk about why Ed was one of the greatest traders ever, because he had a super edge at a time when he was maybe the only person who had that edge. He was a computerized trend follower. When I looked at his computer at one point, all his systems were written in assembly language. Like, nobody writes in assembly language, but I guess in MIT in the 1960s he was. So he was computerized trend follower with all these programs written in assembly language, who understood position sizing about as well as anybody. When nobody else was doing that, that was a huge, huge edge.
Yeah, we've talked about that. I've talked about that with him. It kind of gets to that point. Was it Gladwell that made the point in his one book that at certain points in time, this doesn't take away from anyone's genius, but there is a built-in advantage if you happen to come along at a certain point in time. And usually you can kind of look at certain years and say, gosh, that was the perfect time to be there.
Well, I mean, you can see a lot of these, like John Templeton, when he retired from Franklin Templeton in 1999, took his entire net worth and shorted all the dot-coms. And I'm going, if you know what was going on in 1999, those things were jumping as much as $50 a day in price. And to have a position in something like that and be able to stay the course on it was pretty amazing.
That was near the end of his career, yeah? I mean, that was...
Yeah, I mean, so there's certain things that people do like that that's a huge edge that comes out of nowhere, and they just get the insight, and, then they become one of the all-time greats and geniuses, but they were at an edge and had the right thing at the right time. Warren Buffett, for example, figured out how to buy an insurance agency and trade through the insurance agency and not have to pay taxes on what he was trading because he was an insurance agent. Again, a huge edge.
You're saying, for those out there that might be listening, that if they want to investigate how Warren Buffett has made his, 45 or 60 billion or whatever it is, it wasn't exactly through, quote, just buying and holding.
Well, he didn't have to pay any taxes on the money he got because he was trading through an insurance agency. That's a huge edge. He bought Berkshire Hathaway, which was an insurance company, and then traded through that.
Hey, while we're talking names, one of my most popular guests on this show in the last 4 years is Tom Basso. He's appeared 4 or 5 times. And I actually made an episode where I took all of Tom's appearances and turned it into like a 4.5-hour episode, which is probably my most popular episode. But I know you've had some experience with Tom, and I would love for you to pass along an insight, or, Tom's retired now, he's still trading, but pass along an insight about why he has had such an effect on a lot of people. He's a really interesting guy.
I know Tom really well. We did a number of workshops together. He was involved in a whole bunch of our workshops for 4 or 5 years. I actually helped. It was due to me introducing him to Jack Schwager that got him into the second market wizards. Tom was probably the most mechanical trader I've ever seen. He basically said, I'm a businessman first and a trader second. I look at everything. If it can be automated, if a human being does it multiple times, then I can automate it, and that's what I tend to do. He had 3 or 4 systems going. I really have no idea what exactly those systems were, but I remember at one point we talked about random entry. He plugged in random entry into his systems and still could make money with them, so proving it was all exits and position sizing. Tom was one of in my book on position sizing, all of the things of constant volatility and scaling out came from Tom. And probably the most interesting thing about him was his mental rehearsal, so one time he was in St. Louis running his company, and I called him on the phone, and Tom said, I can't talk now, Van, we're having an earthquake. I'm sort of thinking, St. Louis, earthquakes? And then later on, it turned out he was running his entire operation on his laptop and cell phone because they were having an earthquake drill. One of the biggest stressors for traders typically is when they moved, and Tom moved his whole operation from St. Louis to Scottsville, Arizona, and they didn't miss a beat because they rehearsed everything ahead of time. And then Tom had a thing. He developed an exceptional mental skill because for many years, I think he started as a teenager, he said he used to watch himself do things at the end of the day, and at the end of the day, he'd play a movie of his day and how it went. And because he did that every day, he soon developed the ability to both, in NLP we call it associate and dissociate. So most of the time you're in your body experiencing it like you're in your body, but he could also be an observer outside of his body watching himself at the same time. He was the only one I knew of who ever had the ability, and then I discovered that if you did that technique of watching yourself or playing a movie of yourself every day, at the end of the day, as a review of the day, that skill tended to develop. So those are a few of the interesting things about Tom.
Let me ask a follow-up to that. You mentioned that he said he was a businessman first and a trader second. Can you clarify what he meant there?
Again, this is the meaning I give it, which is not necessarily the meaning he would give it. So you have to assume that my interpretation is correct, which it might not be. Well, for one thing, he was a business owner, which meant everything was, he thought about it all as a business rather than as a trader. I actually have all of our super traders make business plans once they've done all the psychological work that's like 150 pages long, and it's kind of planning out everything, understanding everything. Another aspect of being a business is the fact that Tom could take off time for his trading and maybe do 2 workshops with me, helping me out, and know that his business would be running smoothly. That he could probably take a month off and know that the business would be running smoothly because it was a bunch of automated systems. So I think it was the way he viewed it. And I don't know if I explained it exactly, but that's probably the best I can do without being in his head and seeing the maps that he actually has for it.
I can remember the very first time, I've talked about this before, when I entered Bill Dunn's office in the mid-1990s, and there were no screens on anyone's desk. It felt like I was in a CPA office or a law firm. And I think that is also getting at the idea of like, it's not about, I think so many people, even if they're bright, so many people approach the markets and they have that extra kind of excitement thing coming from the greed side of them already, ginning up inside of them. But the reality is when you start to meet these people that have been the superstars, it's not about that in any way, shape, or form.
Typically, the superstars find some sort of edge that becomes rather unique for them and are willing to really exploit that edge. They basically understand that there's certain fundamental principles that are unique to success, and they also operate within those principles.
Van, let me shift gears on you a little bit and thinking about something Tom said about the simulation, but taking it more towards a trading simulation. So most trading simulations, backtesting, using computers, this is something that you are putting rules into code and testing its math. There's not as much room for discretion except at perhaps the initial choices. But it doesn't stop people from thinking, even if there is so much success in the automated or the systematic mindset when it comes to trading. Many people still, my feeling is, still believe that there are many market wizards out there that are sitting at the cockpit, so to speak, each day with a discretionary and intuitive, gene or extra something. Why don't you contrast? Because I don't know if you're a pure discretionary trader, it seems like to me it'd be very difficult to implement some of the position sizing methodologies that's in your work.
I think that part of it has to be you have to know when something's not working anymore. So that's definitely discretionary. For example, the market type may have changed. And that system, it's late 1990s, you're making a ton of money buying growth stocks, and you think you're a genius, and then 2000 comes along, and the market's totally changed, and you need to know that. If you're not aware of that, you're not going to do well. So you've got to be aware of things like when the market change. But I also think there are subtle things that happen within the market that make it so that things no longer work. So you like trend following. Let's talk about a trend following example. Maybe in the mid-1990s, I have a guy who teaches at the Army War College, and he's got a master's degree in systems thinking, and he's got a PhD now in decision making under stress. And he developed a fairly simple mutual fund switching system where he had a basket of mutual funds, and every month he ranked them on their relative strength with over the last 6 months, 3 months, and 1 month, with the biggest ranking being the last month. And you'd buy the three strongest, and he'd put a 10% stop on them. And then at the end of the month, if he wasn't stopped out, he'd see if he should keep those or were they still the three strongest or whatever. That was a great system. It outperformed the market, at least during the time it worked. He'd never had a losing year. And, it's a pure trend following system. So you go, great. Well, the first thing that changed was suddenly mutual funds decided that they didn't want you trading in and out of mutual funds. And so suddenly his system totally died. He could not do it anymore. So he switched to ETFs. So ETFs were in the process then. So he switched to an ETF strategy where you had all these ETFs and this whole universe of ETFs. And then I think in Trading Beyond the Matrix, he put the performance of that system. And I think it had some losing years, but it still always outperformed the market and did really well. Well, if I look at the same system now, I can't even trade it because it's a fairly automated system. You just Put in your orders once a month, you calculate it, you put in your orders, have a 10% trailing stop. Actually, it's not even a trailing stop, it's a 10% stop loss, and at the end of the month, you're out, you're either switch or buy something else. But what happens now is if you look at the track record of now and you test that, you basically have at least a 20% drawdown with about 40 months to get out of it. So what's happened? Something's happened with lots and lots of people with big money doing things with ETFs that make it so that system doesn't work anymore. And there's a new version of it that works but requires a much shorter time frame. Systems stop working too.
Your passion today, Van, why are you doing this? Why are you still doing this? Why are you so passionate about what you do at this stage of your life? Why have you not stopped? Why have you just not gone out and smell the roses?
Well, I turned 70 this year, and it kind of goes back to people used to say, well, if Van knows so much about trading, why does he coach and why does he make money trading? Well, that makes the assumption that the be-all and end-all in my life is making money. It's not. My passion is helping other people, especially other people make transformations that change their lives. Our metaphor for our company is transformation through a trading metaphor. That's kind of our mission. Our whole company thrives on it. We're always getting letters and phone calls from people about how you changed my life. So I get a lot of joy out of that. I see no reason to ever retire until maybe I become senile or something, because I love what I do, good at it, and I help a lot of people, and hopefully we'll keep doing that.
You just mentioned that so many people, you might get feedback. They say, hey, you really changed my life, and thank you for that. And that's a great feeling. I hear that sometimes in my world. Who changed you early on? What was the triggering moment? Was there one triggering moment? Was it a series? When was the change? I mean, roughly how old were you? How did you start to go down this path? Somebody probably had to give you something in terms of an insight or an inspiration to send you down your path. How did that happen?
I would say I started this business around 82. I would say around that, it's fuzzy as to what exactly happened, but around that period, it was probably the low point of my life, and I was, psychologically dead. But I remember going to a religious science church, and I remember a man, somebody asking the minister, or the minister talking about a situation where he said, well, I don't believe in God. And the minister said, well, what kind of God don't you believe in? And they talked about this man up in the sky who passes judgment on us and decides whether you're good or bad and whether you're going to go to hell or heaven or whatever. And the minister said, well, I don't believe in that kind of God either, but maybe there's something else. And at that point, I kind of found A Course in Miracles, and I didn't really understand everything about what A Course in Miracles said, but it totally matches up with what I'm, personal responsibility, about how it's all illusion and you create it through your thoughts. I actually went through A Course in Miracles the first time, which took me 4 years, and I never got that it was all made up. It took me second or third time to figure that one out, even though it's very obvious in there. But it was through that process of really working on myself, as I started to find myself that way, and as a mission developed of, in order to, my job is to help transform traders through a trading metaphor. I also had the belief that I couldn't take any people or help transform anybody any further than I managed to transform myself. It has been, and it still is, a lifelong goal to transform myself. For example, I'm currently taking a Siddha Yoga course that requires me to go to India once or twice a year. And they say in about 10 years I'll become a Siddha Yoga. We'll see that when it happens. But interesting things have happened as a result of doing that. And it's certainly helped me be able to produce transformations much quicker than they were 10 to 15 years earlier than this. I can't put it on a specific thing on what happened, but that, in a nutshell, is kind of what happened.
As a recent person practicing yoga the last 4 or 5 years, maybe we'll save for our next conversation. We'll go pure Eastern, and let me pick your mind on that particular topic. I have a feeling we could talk for a very long time on that alone.
Well, it can be kind of interesting. I mean, I understand, for example, the reason things are all made up is because, and the reason a major transformation is necessary is because our brains get shaped by language. And language basically has the format, almost all languages have the format of subject, verb, object. So they get you, once your brain is shaped to think that way, then you assume it's real. There's me, there's you, and there's our relationship. And there's me and the market and my relationship with the market. But that's a function of how we think. I think the only language I know of that doesn't have that relationship is Sanskrit. And Sanskrit doesn't have an I sense.
Interesting. For those of us that grow up in Western traditions, that is a dramatic shift.
Yeah, there's no sense of I in Sanskrit. In fact, early Sanskrit words didn't have any meaning. It was the sound and the impact of the sound that it had on your body in creating things. And it was only later that words were given meanings. Didn't mean to inject all that at the time, but it came into my head, so I said it.
No, I think my intuition was right. I think our next conversation perhaps goes right down this path. Van, in the short term, though, the near term before our next conversation, iitm.com is where everyone can find you, or is it vantharp.com as well?
Vantharp.com is probably easier to remember.
I always remember the IITM from back in the day. I don't know why I've never forgot it. I don't remember the Van Tharp, but I remember the 4-letter one. There's not many 4-letter domains out there. I actually own one 4-letter domain myself. There's not many of them out there that are available, at least.
Yeah, and as we said before, my book, Trading Beyond the Matrix, is basically free. You have to pay postage, which is media mail if you live in the United States. It could be expensive if you live out of the United States. It's free. It's a really good introduction to what we do.
Van, I thank you for taking the time again today. I always appreciate it.
It's my pleasure. Yeah, I always enjoy it.
Number 4, Daniel Crosby. I really, really enjoyed his book. It gets into a level of detail that really makes you think. Very well done. The efficient market theory. This is not something every investor knows about, but they should. And I have to say that recently, probably in the last 2 months, I watched a video, an interviewer interviewing Eugene Fama and Dick Thaler right there in the same room. A really fascinating interview. As far as I could tell, they didn't agree about anything. They didn't agree about anything other than they respected each other for their academic achievement. So they didn't seem like they were mean or nasty to each other, but they just didn't agree on anything. I would tend to think that I'm going to fall over on the Dick Thaler side more so, but he's also a little bit different camp than other people. In fact, I have to be frank, he so far has not granted me an interview. And the funny thing he said to me at one point in time, he said, well, if you like Dan Ariely and you like Gerd Gigerenzer, you won't like me. So I was my first taste of the competitiveness in the behavioral side of things. Beyond that, let's start to break apart the efficient market theory. Why don't you, for the audience, put your best teaching cap on and explain it, and then we'll start to tear it apart and look at it from different angles.
In the simplest possible terms, the efficient market hypothesis says that the price is always right. So, the price that you see is the correct price, or at least the closest to the correct approximation of a price you'd ever get, and that you can't beat the market. Those are sort of the two legs to the efficient market hypothesis. And it's interesting. You mentioned Gerd Gigerenzer and Thaler. Those guys hate each other. So even, there's a lot of disagreement between the efficient and the behavioral camp, but even within camps, there's quite a bit of dissension.
And I'm less familiar with, and this is kind of a side note, I'm less familiar with all of Dick Thaler's stuff, but I've read Gerd Gigerenger's Risk Savvy. He's been on this podcast several times. I don't see anything that causes me, from a logic standpoint, to go, oh my gosh, that's the end of civilization. What Gerd just said, it just seems very, in many ways, common sense, plausible. So I guess, like you said, some of these debates get off pretty intense, huh?
Yeah, absolutely. And I think sometimes, where it goes bad is when they devolves from sort of critiquing ideas to critiquing individuals. And I think that's maybe where that one's gone.
Yeah. Well, there's no doubt. I think when you get, and I'm not talking about these folks, but look, I'm not an academic, but I had enough experience in academia to know that some of the personalities and egos are pretty big.
Yeah, no doubt.
Let's dig a little bit more at the efficient market part. The markets, you can't beat the market. So I've been at this for a little while, and I've kind of in this one strategy, this time series momentum, otherwise known as trend following. Gosh, it sure looks like to me there's a lot of evidence that you can beat the market. That is momentum on that side. Then you've got Warren Buffett, you've got Howard Marks, you've got all these people out there that have done quite well. Seth Klarman, there's a whole army of people that have, quote, beat the market. And then on top of that, I guess when I look at 2008, I don't know where the efficient market hypothesis or theory, how that explains what happened in 2008.
Yeah, well, I think that's why you're starting to see it break down. I mean, you're starting to see it break down in the face of these bubbles, panics, crashes. And, the thing, so to try and argue the other side, because I don't believe in the sort of the strongest form of the efficient market hypothesis, and I don't think many people do, frankly, anymore. But, the strong form efficient market theorists would say, look, you've got however big the number is, tens of millions, hundreds of millions of people in the market. Probability says, even if you have monkeys throwing darts at the Wall Street Journal, you're going to occasionally get a Warren Buffett, a Seth Klarman, a Howard Marks, a Joel Greenblatt, whoever. And so they say, look, you're gonna get some winners in a system that big. There's nothing special about these folks. But I think where that breaks down is certain types of investing have consistently outperformed, specifically value and momentum strategies have consistently outperformed, which leads me to believe that maybe it's not monkeys throwing darts at stocks, but maybe it's something about these strategies. And in my book, I talk about, I think that the reason these strategies have persisted is because there's a strong psychological underpinning to both value and momentum approaches, which is hard to arbitrage away. I mean, it's hard to arbitrage away bad behavior.
Let's talk about rules for a moment. This is something that's big in your work. So for me, I know more about the trend following side, and most trend following strategies apply today. Again, for people that want to call it something else, they can call it time series momentum or whatnot. But most of these strategies are literally automatic. They're 100% systematic. It's all rules. Shed some light for the audience out there that might be wondering, and also too, I think you'll find the population of trades in some of these momentum strategies. You have so many more trades, so for this to all be kind of luck is kind of crazy. But on the flip side, I think one could make an argument, and I would love for you to elaborate on this. On the value side, are things as systematic? And on the value side, you could have a situation where a value player has made a half dozen brilliant long-term bets in their career, and that alone can really make you a superstar in investing lore.
It's interesting you bring up something a gap that I think I'm trying to bridge in the book. Typically, you've thought of trend followers, momentum folks as quantitative, higher frequency traders, whereas the value folks have been, have traded less, have had more concentrated positions, perhaps. And have been more of a discretionary mindset. I talk about rules-based behavioral investing, and one of my pillars of that is something that I call consistency, or just following rules. And I do identify as sort of a combo value momentum investor, but I think that anyone who's a behaviorally informed investor is going to fall down on the side of rules. In the book, I cite a meta-analysis. So this is a study of all the studies on following simple rules versus leaning on your own discretion. And when we're talking about discretion in these studies, we're typically talking about expert discretion, PhD level discretion in everything from prison recidivism studies to stock picking to making a medical diagnosis. And what they found in these over 200 studies is that expert discretion is beaten or matched by following simple rules 94% of the time. And at a much greater, at a cost savings, of course, because you're not paying, 10 CFAs to go out and meet with managers and try and make these discretionary decisions. So there's the big cost savings, and then there's also the headache savings. I mean, you can kind of go live your life instead of, being up at 2 a.m. to look at Chinese soybean futures or whatever. So, this is something that I think that makes a lot of sense. The research says it makes a lot of sense. You can do it more cheaply, and you can also do it with a higher quality of life. So I hope this is where the industry's headed.
Not to be a homer for my world, but I guess in your work kind of opens up this discussion. When I think about the trend following type strategies, which are way, way, way away from high frequency stuff. I mean, it's much more longer term. I mean, you could have trades on for well over a year. To me, it seems like it's the perfect example for showing the problems with efficient market theory and the benefits of the behavioral side of things, because you have these 100% systematic type strategies that are showing this long-term performance. I mean, look, you've seen the studies as much as I have. The time series momentum studies are in. This works. But it's so just naturally fits, like dovetails with everything that a Daniel Kahneman and Amos Tversky did. It just dovetails completely. And again, I'm not bringing this up to try and push trend following. I'm just saying it's an interesting example, especially in the spirit of where you've gone in your book.
So I think it's interesting, and I think you're seeing a push towards a greater acceptance of trend following within what we'll loosely call the behavioral community. Because to be candid, there's all kinds of, there's two or three handfuls of people who I think identify as behavioral finance informed investors, and most of them I would classify as high conviction value shops. But I think increasingly you're seeing people come around towards trend following, towards acceptance of momentum, because we're beginning to recognize the sort of psychological underpinnings of these things. We're recognizing that some of the reason that momentum persists is because of people's tendency to overreact or underreact, or our tendency to update our preferences slowly, our tendency to project the now into the future sort of indefinitely. And so I think a lot of behavioral folks reacted negatively to charting and trend following and related concepts because it was sort of seen as voodoo. But I think that as we build behind build the psychology behind these concepts, I think they gain greater acceptance in my world, for whatever that's worth.
Yeah, it's we could go off on a side tangent here for a while. Maybe we'll do that on a second conversation. I want to bring you into the heart of the matter, though, your work right now. Give me some backstory. You're a relatively young guy, but your work is pretty deep. I mean, I've gone through, and I mean, you're looking at all the different. You're turning over all the right stones, that I would want to turn over, and things that I was not aware of. How did you get your start? What's the backstory of why you are even in this space right now?
It's a weird story. So I started out. My dad is an investment manager. My dad's a financial advisor and investment manager. So I grew up kind of steeped in that world. Started out college with an eye to following in his footsteps. A couple years into my college experience, I dropped out for a couple of years to go be a missionary in Southeast Asia. Came back from having lived in the Philippines for a few years with sort of this, we'll call it a bleeding heart, so to speak, and wanted to do good in the world, and said, you know what, I'm going to be a psychologist. I'm going to go do good in the world. Got about 2 or 3 years into a PhD in psychology and realized that I didn't want to talk to sad people all the time, but I did really enjoy thinking deeply about why people did the things they do, and found the market to be just a really natural backdrop against which to measure human behavior. I mean, the amount of data that we receive, The sort of real-time updates you get to human sentiment are fascinating, and it's frankly something that clinical psychologists aren't afforded in the same way. And so, yeah, I've just been real lucky to kind of have two great loves of investment management and human behavior, and be able to combine those in a satisfying way. So that's sort of how I got my start.
Well, going through your book, I love the idea, and I would love for you to tell this story, but I love the idea that you're willing to take a chance, to go out on a ledge, to walk the plank with something extremely different, to bring people into a new way of thinking, a rules way of thinking. I want you to explain the guinea worm story.
I tell you what, man, everybody loves or hates that guinea worm story. So I grew up in Alabama. I live in Atlanta now. I love the South. The American South is such a weird and wonderful place. And so I tried to start out the book with an Atlanta story. And one of the things that I think Atlanta is under-recognized for is being the center of epidemiological research really in the world. And so we've got the Carter Center here. Of course, we have the CDC. And one project that the Carter Center and the CDC did together was, for the first time in human history, they eradicated a disease for which there is no cure. And that disease was guinea worms. And guinea worms were infecting millions of people each year in Africa, were decimating economies and the prospects of people who lived in these countries. And there was no cure for it. I mean, there was no pill, there was no shot, nothing you could do. And so they said, we're going to have to take a different tack. And so the way that it works is, when you get guinea worms, they exit through your feet. This is kind of more disgusting than you usually get on the podcast, but they exit through your feet. And the only way that you can get relief is to go put your feet in water. Well, in these villages, there are communal water sources. And so, someone runs selfishly down to the water source to get this relief, and ends up infecting the rest of the village. And so what the Carter Center and the CDC did, they came up with behavioral interventions, which were basically teaching the villagers to identify and then to quarantine, to just sort of create a social construct whereby, look, if you identify your neighbor or your sister or your brother has guinea worms, you do not let them go near that water source. You keep them where they are, and you make them gut it out. And by doing this, they literally eradicated millions of cases of guinea worms a year, and have saved the economies of a number of sub-Saharan African countries. And so the reason I relate this story is because following a few simple rules, they brought about this, frankly, miraculous effect of something that's never going to go away until we come up with a cure. And I think investors are likewise saddled with this disease of irrational investor behavior. I mean, I think we're about as ill-equipped to invest as we are to do anything as a human family. But by following a few simple rules, I think we can have similarly powerful effects.
I was just thinking of an economist named David Ricardo. You've probably, I think he's actually quoted in your book. A very simple set of rules. Let your profits run and cut your losses short. Look, he set that foundation down hundreds of years ago. I think it's a fair statement to say that perhaps Nobel Prizes have been awarded out to other people for that work that he figured out years ago. But that's a simple rule. But, that simple rule, cut your losses short, let your profits run. As a trend following homer, I have to say that's trend following foundation number one. But that simple rule is extremely difficult to get across because everybody wants to buy more when the price starts to drop.
Yeah, so I mean that simple rule is exactly the opposite of what we're prone to do, because we have this tendency to want to get back to zero and lock in our gains, right? And so what we tend to do is sell our winners short and let our losers run. And so that's exactly the opposite of what we tend to do. So the thing about investing, and you see this throughout the book and throughout the research, is none of it's rocket science. And sometimes I get a little frustrated. The ideas with which I invest and the ideas I write about are so simple, but they're not easy. And so you need rules, you need an advisor, you need whatever to help constrain your bad behavior. Because as simple as that rule is, it runs 180 degrees against human behavior.
When you say, though, easy, easy is relative to what one knows at a certain point in time. So for certain populations, it won't be easy. For perhaps some very experienced populations, I had a conversation with a guy the other night. He was featured in the Market Wizards book, Larry Height, and Larry was just basically telling me it's so easy. And I don't want to make it sound bad, but he was kind of like, it's so easy. It's like robbing a gas station or something, he said. It's like, just because he's been doing it for 40 years and he knows deep in his bones that, like, if he's got a loss, he's taking the loss.
Yeah. Well, the reason that I think these things stick around, though, is because they sort of do go against the grain of human behavior. And so, I think these things are going to persist. Whereas sort of these silly little anomalies like calendar effects and days of the week and things like that are easy to arbitrage away, it's very hard to get the crowd to move against its base impulses. And because that's the case, I think that any sort of investment discipline rooted in psychology has a better chance of sticking around.
So let's get to the really, really big picture of your work, and then we'll start to backfill in too. You point out the paradox. The paradox is we must invest in risky assets, because if we don't, we're just going to get, the 0.5% or the 0% of negative interest rates or zero interest rates. But on the flip side, your premise is, okay, we have to take those risky choices, but to take those risky choices, you need essentially, and I'm paraphrasing here, mentorship. Why don't you explain this paradox from your perspective?
Yeah, so the paradox, God couldn't design a worse investor than the average human being. So many of the rules, we just talked about one, so many of the rules of investing run contrary to what is simple and easy for us to do in our everyday lives. We don't do well with uncertainty. We don't do well with volatility. We live in the present and not in the future. All these things are hard for us to do. So one of the things that I talk about in the first part of the book is the need for a lot of people to get guidance. You talked earlier about the gentleman who said it was so easy because he's been doing it for so long. But one thing I cite in the book is that we lose 13% of our IQ under duress. And so even if someone's a regular listener of your podcast, has read all your books, has read my book, whatever, has done all these things to educate themselves, that knowledge tends to be out the door when we need it most. And so, I talk in the book about the research around people who work with professionals versus those who don't, and how those who work with professionals tend to do much better. And it's frankly not because most investment advisors or even most stock pickers know what they're doing. It's because they keep you from making a handful of really egregious mistakes over an investment lifetime.
If you can't have the rules that you're going to stick to, buy, sell, how much you're going to buy or sell, here's the portfolio. If you can't have that, why play?
Well, I think a lot of people engage in it as an ego exercise. They want to prove how smart they are. They want to be the master of that destiny, and that's an impulse that I understand. Elsewhere in life, if you do more, you get more. But in investment management, so often when you try and overcomplicate it, you get less. It's a natural impulse again, but not one that leads us to a very good place.
You mentioned ego. I'm quoting from your work, which you're quoting from another work, which is, you're not special. You're not a beautiful or unique snowflake. You are the same decaying organic matter as everything else. And that is from the Fight Club.
Fight Club, yeah.
So what made you think that Fight Club was appropriate to go in this work? Might scare off some of the rather conservative, older, stodgy investors. Doesn't scare me off. I know why you put it in there, but what was your thinking?
So many times we know the rules, but think they apply to other people. I spoke with my best friend, lost his dad this week, and he said, "Look, I know bad stuff happens. I just never thought it would happen to me." And I think that his experience is so reflective of our human experience. And when you look at studies, we tend to delegate the dangerous and own the advantageous. When you ask people, how likely are you to get divorced or get in a car accident or, get cancer or whatever, people rate that likelihood as extremely low. When you ask people how likely are you to win the lottery or pick great stocks or, yada, yada, people rate that as extremely high. I think the hallmark of a good investor is realizing that the rules do apply to you. The rules do apply to you. This isn't just something that applies to other people. And I think a failure to own that the rules apply to us explain a lot of bad behavior, why people don't follow investment rules, why you see stuff like home bias, why you see people locking in bad tendencies around when to buy and sell. So I think you have to own the fact that you're no better, you're no more special, you're no more gifted than the next person if you're going to be truly great. There's, again, a paradox in owning your own imperfection on the way to doing something special.
Even though the wisdom of the Stoics and perhaps the Eastern Zen traditions go back millennia, for the average, say, the average American, I don't think Stoicism and Zen perspectives is really something that we grow up with. It's maybe when you get older and you kind of like start to get exposed to somebody that walks you down that path. But both of those traditions really dive right into where you're going.
Well, they do, and you're right. I think these are understudied in America, and I think it's very consistent, this idea of being sort of a roll up your sleeve, be a hardworking, gunslinging, stock picker.
Hey, don't pick on the gunslingers. Don't pick on the gunslingers. I got a lot of Second Amendment guys in here. I'm probably one of them. So.
Look, man, I'm from Alabama. You're not gonna find me picking on gunslingers. But you know what I'm saying. I mean, I think there's something that's very red meat and apple pie and baseball about doing fundamental research, picking 10 stocks and living and dying with that. Unfortunately, the research doesn't necessarily back that up. But I agree, there is something very American about that way of doing things, even if it's problematic in some way.
Because I think also too, maybe we get a little bit caught up in the big story. I mean, really, it's kind of crazy that as long as America's been around, for as many successful investors as there have been, really most people only think of Warren Buffett, and that's it. I mean, and there's no other Warren Buffett exactly that I know about. He's had, he set this up a long time ago. There's first mover advantage. He has a unique structure. I take nothing away from him, but the idea that Buffett is, a half dozen stocks that he picked a long time ago and held on for dear life and now has made a fortune, that's not exactly what happened. And it is a touch more complicated than that.
Well, I love Buffett, but even a lot, there's a strong element of do as I say and not as I do with him. I mean, he's bad-mouthing derivatives while owning them, and I get it. Look, he's speaking to folks in Nebraska or folks at his meetings, and they shouldn't be operating at the same level of sophistication that he is. But yeah, I mean, there's sort of the quotable Warren Buffett, and then there's Warren Buffett in practice.
Which can cause confusion, to say the least. I mean, because he's like the number one example. And if you really dig into his work very respectfully, he understands the use of leverage. He knows what the Kelly criteria is. I mean, he's a very bright guy doing very bright things with his partners.
Yeah, absolutely.
Yeah. Let's jump into something very simple sounding, but I think you can tear it apart. We control what matters most. And I would argue that what matters most is controlling loss. And if we go into the markets, we all have the ability to control how much we are willing to lose, don't we?
Yeah, we do have some control over that. Now, that first chapter, You Control What Matters Most, is trying to reinsert some ownership and some pride and ownership into the investment conversation. Because I think when you speak to most people, and indeed the research backs this up, when you speak to most people, you say, hey, what's the best predictor of your ability to meet your financial goals? And they're going to say, well, it's going to be the economy, and it's going to be Janet Yellen, all these externalities. Well, all the research shows that most investors tend to leave about 50% of their gains on the table because of poor behavioral decisions they make. And this is over long periods of time. And most investors just barely keep up with inflation. And so again, this is why I'm advocating and you're advocating a rules-based approach, is because far from taking advantage of all these anomalies that we've talked about, most people are doing well worse than average, which is why you see people like Warren Buffett, Dick Baylor, and others who, while they don't believe in the efficient market hypothesis per se, sort of espouse an EMH brand of investing to retail investors. So this is me trying to say, look, you are the best predictor of your success or failure. So own that from the outset and don't blame it on the market.
I mean, I think your work is really kind of a can opener to all of these issues. I mean, you're not trying to say there's one magical answer, but look, you got me sitting here with a bunch of notes in front of me who went through everything and was like, okay, I want to talk about that. I want to talk about that. But let's also speak to something that I'm seeing a lot right now. So I can still remember that feeling in March of 2009. In March of 2009, there was no investing strategy that said in March of 2009, it's time to go long. There was none. There was nothing that said that it was time to go long, because in March of 2009, it sure as heck felt like the market could go down another 50%. However, from March of 2009 to October of right now, October of 2016, it's been one heck of a run. And I've just started to notice in a lot of the major publications, financial publications, all these people are getting all this notoriety for running passive index funds. It's all the rage. You know, there was a big mutual fund the other day that we got a lot of press, you know, how smart they are to be running the passive fund. And I think it was the Nevada state employees guy. He's one guy running, I don't know how many billions, and he's got no employees and he eats his lunch at his desk and he's running a passive index fund. What I don't get about that is that if we have another 50% drop, which I think is more than an if in the future, because we've had a couple in the last 15 years, just in the overall equity indices. I mean, are people really going to be comfortable with the idea of like, well, we took the passive index fund and it dropped 50% and we're happy with it? And then on top of that, I know it's kind of a long question, but on top of that, what happens if we do get the 50% drop for the third time in 15 or 16 years, and then we go Japan? And it never goes up again and stays down 50% for 30 years. I mean, it's kind of a crazy strategy, in my humble opinion. Am I completely off my rocker?
So, yeah, there's a lot. Let me try and dissect it. You know, one of the chapters in the book is called Excess is Never Permanent. And some of my research, there's two sort of major streams of research I have. One is around developing quantitative measures of investor sentiment, and the other is around developing a composite quantitative measure of broad equity market valuation. So right now in the U.S., my metric has us at about just south of the 90th percentile for the S&P 500 relative to history.
What does that mean exactly for you?
That means it's as expensive as it's ever been in history, more or less, with the exception of maybe 2000. So we're in sort of 2000 and 1929 territory with respect to valuation.
Half my audience just left the conversation. They are now in their bunker with their shotgun.
Yeah, I told you I wouldn't speak ill of guns. So, I mean, that is what it is. You know, what we can know is how expensive things are, and we don't know exactly when that's going to turn. I mean, I think trend followers can watch for that turn and take advantage, catch a 10% dip instead of a 50% dip. But there's no denying that these things occur, and that they occur with greater or less severity relative to how tightly stretched valuations are. I mean, I conceptualize it a bit like a bow and arrow, right? I mean, if you stretch that string very tautly, when you let it go, you get the arrow gets propelled at a higher rate of speed. Similarly, I think when you stretch valuations to the point that they're stretched now, when you let go of that arrow, the momentum starts to flag. I think you get, a very, very negative reaction. In that respect, I think people who are passive are going to have a very bad time. Over history, you could have also done a lot worse than being passive over the last 10 years, because frankly, so few quote unquote active investment managers, I think, are doing it right. One of the things that I talk about in my book is how 3/4 of what are marketed as active funds are really closet indexers. And so I think that, unfortunately, a lot of the reasons why active management has gotten a bad reputation are very well earned. You know, you've got expensive, low conviction products that aren't following rules, that are making investors susceptible to all of the behavioral biases of the managers. All the research shows that active investment managers, by and large, tend to do all the wrong things. They tend to sell low and buy high and do everything you shouldn't do. On the one hand, I think active management has, by and large, earned its bad reputation, but I do think in the medium term that passive folks are in for a rough ride. And I think all this stuff's cyclical. You know, I mean, we've had an unbelievable run. I mean, if you just bought the S&P for the last 7 years, you've been beating everybody. And so you get articles like the ones you're seeing, and I think the tenor of those articles will change sometime in the near future.
You know, whether it's active or passive, really, it's so much of Wall Street just comes down to fees, and it's whatever smart guy or whatever smart group can slosh the money around from this pile to that pile and try and get a fee. So much of it's that. Why don't you also speak to the passive guys, though? Because the passive guys are indoctrinated in the school that we brought up in the beginning of this conversation. The passive guys are all indoctrinated in EMT. These aren't behavioral guys, by and large.
What I've tried to do with my work is show a little bit of a middle ground. You know, if on one extreme we have buy and hold passivity, on another extreme we have, the 10 stock, deep research, high conviction, active management. I try and be somewhere in the middle. I mean, I try and show that, look, there are some things that are really laudable about the passive management movement. You know, managing fees, tax alpha. You know, little things like this make a tremendous difference over time. Diversification, things like that. But I do think that there's a middle ground, and I do think that you need some sort of protection. And decreasingly, it's getting harder and harder to get that protection through just sort of a simple diversified strategy. I mean, you know, the only thing that went up in 2008, 2009 was correlation, right? Like, no matter what you were holding, you were in trouble. And so I do think that there needs to be a greater element of risk management. And another thing that I talk about in the book is, you know, with increased information in our age, we're not seeing markets get more efficient. We're seeing them get less efficient. I mean, you're seeing more and more dramatic and more frequent bubbles, panics, and crashes. And I think that the new normal is we're going to see dramatic rises and falls, partially as a result of how closely we're monitoring all of this stuff.
You know, you mentioned you kind of hinted at the heuristic, the idea of too much information. So we have too much information, and I look at my world, the trend following world. You know, they got the heuristic of price action. So instead of trying to go through all of the fundamentals, which I think is impossible, one just says, you know what, I'm going to trade this price action. In many ways, I think this can be hard for people to accept about time series or even cross-sectional momentum. It's not really investing in any way that we really know about. It's literally like a kind of a video game of just trading price movement. It has nothing to do with value. And I think that alone can cause people to be like, man, I just can't wrap my arms around this.
I set out sort of 4 pillars of what I think are a sound active management approach. And one of the pillars is what I call clarity. You know, it's a very American idea that more is better. A lot of people want to look at every possible variable they can, right? And so I talk about why that really doesn't make sense. And I show some of the research that shows that at some point, considering more variables actually gets you a worse return. And I talk about how the Fed releases 45,000 pieces of economic data each month. And you just can't make sense of it all.
You got to make buys and sells. I just don't know how any of that translates to buys and sells.
Right. Well, and so I'm not a strict momentum investor. I do incorporate it into my strategies. But one of the things that I think is nice about your approach is it relies on one signal more or less. You know, and I think there's some cleanness and some clarity to be had with that.
Let me let you clarify all four of those really quick. You kind of call them the 4 C's: consistency, clarity, courageousness, and conviction. Why don't you go through those 4 really quick so people have a good broad overview?
So the first is consistency, which is the rules-based approach that we think that's been well covered at this point. The second is clarity, which is I look at just a handful of metrics, because again, at some point, the information begins to cannibalize itself, or you do what Nate Silver calls, something. He said something to the effect of putting all this information in a blender, blending it up, and calling it hot cuisine. It's not, right? We need a handful or less of important, impactful things that you look at. The third is courageousness, which is basically automating this process of buying low and selling high, or like you talked about, letting your winners run and selling short your losers. And then the final one is conviction, which is sort of, I refer to it as sort of Goldilocks conviction, finding that nice sweet spot between owning too few stocks, because I'm shocked as I go out and speak how many people will come up to me and say, look, I work for Lockheed Martin and I'm all in on Lockheed Martin stock, or I'm all in on Apple, or whatever it is. I see that with surprising regularity, and it pains me. So finding that sweet spot between holding 1 or 2 stocks and being over concentrated, and then owning the index, which is no conviction at all. So I talk about trying to find that sweet spot and set aside some of the research around that.
Let me get schizophrenic on you and whip you around to a completely different area. So, for a man that has studied quite a bit of psychology, a little bit of psychiatry, I'm sure as well, tell the audience out there what they can learn from his teachings, his writings, the insights. How can Sigmund Freud help us all as investors?
Oh my goodness. How can Sigmund Freud help us as investors? Oh my goodness. So that is schizophrenic. So Sigmund Freud gets a bad reputation for being all about sex, right? And I mean, indeed, that was what underlied a lot of his sort of the motivating animus for his theories. But Sigmund Freud's work is at the base of pretty much any psychology you'd like to study. And so the way that I think his work impacts us, I think, is in sort of a behind-the-scenes way. I mean, he's the one that introduced notions like an unconscious mind, like things happening, biases and heuristics and decisions happening sort of beneath our awareness. So he set these things up at a time when they would have been outlandish to people. And we accept this as very, very much factual now. I think that the way that Freud's work impacts us is that he blazed a trail by introducing ideas that were heretical at the time, that are very much now just a part of our daily life, that are so deeply interwoven into the theories of people like Thaler and other prominent behavioral economists that you don't even recognize them.
Yeah, I think it's a great point, because I've had so many behavioral guys on my show, and I think maybe I have a quote or two in one of my books from Freud, but it makes me, when I was reading something in your work, I was like, I got to go do some more homework. I mean, obviously it's not my background, but it makes me want to go do more homework, because as you point out, it's the foundation.
Oh yeah, he doesn't get enough credit, if that's possible, for doing the hard work of making these ideas just enter the public consciousness.
I'm going to jump around on you again. Look, there's a lot of jumping I can do here. I could jump around for about 5 hours. Trouble is opportunity. I like that a lot. I've seen it said in different ways, but those 3 words together are really nice. However, for most people, trouble is opportunity. Hold on, I don't want trouble. I don't want any trouble. Well, trouble is opportunity, isn't it?
Yeah, trouble is opportunity, and I think again, this is one of those things that everyone knows and no one does. And I talk in this section. I try and erode people's notions of free will, I guess, in this section, and I talk about some of the research around willpower. So everyone thinks that, hey, when it hits the fan, you mentioned March of 2009. When I get in March of 2009, I'm going to be all in. That's when I'm going to get aggressive. I think we need a couple of things to take advantage of the March of 2009s of the world. The first is we need a metric to show us, again, sentiments and valuations. This is why I measure these things. I mean, we need a way of quantifying, where are we relative to history? What kind of opportunity do we have? Because my sentiment measure was at a 5 out of 100, 0 being sort of the hypothetical lowest possible. I was at a 5 out of 100 in March of 2009. Lowest sentiment I've ever seen. I could have told you then, using that measure, hey, this is likely a good time to get going. Whereas most people, if you're just relying on your emotions, it feels too dangerous. So I think one thing that we need to take advantage of trouble being opportunity is some sort of objective measure of what sort of opportunity we're looking at. And then the second thing I think we need is an understanding of how poor our free will is, or how our free will acts. I talk in the book about marital infidelity, and people think that marital infidelity probably is highly correlated with something like religiosity or sort of self-professed morals. But the best predictor of marital infidelity is opportunity. Basically, how rich are you and how good looking are you? The best predictor of whether or not you're going to sleep with someone who's not your spouse is if anyone wants to sleep with you, which is basically, a nice a nice way of saying we're not as strong as we think, right? We're not as strong as we think. So we need to set up rules that keep us from making poor decisions. So this is, again, another instance where in order for us to take advantage of trouble being opportunity, we have to have a rule in place, a system in place, an automation in place that makes us do the scary thing that we don't want to do.
You mentioned March of 2009 again, or following up on what I said. The other side of the coin, from instead of the value perspective, could have been once it hit its lows, somewhere off the low, moving up, trending up, a breakout, a moving average, something from a trend following perspective, a time series perspective would have got you in. So there's different ways to skin the cat. I don't think anybody picked the exact bottom, though, or very few did.
Oh, no. Well, and I think being a behavioral investor means you give up the notion that you're ever going to pick the tops and bottoms, right? I mean, you're never going to get perfect at calling tops or troughs in the market. But what you can do, though, is use a momentum strategy, use a value strategy, or I favor some combination of the two. Because what I found is that mean reversion tends to be stronger or weaker depending, again, on how stretched we are from fundamental value. So if you pair a value strategy with the momentum strategy in a March of 2009, and you say, look, we're at a very depressed valuation, and look, now the sentiment, the momentum starting to turn to, here's two good signals that tell me it may be time. So I think that pairing those two things is awfully powerful.
So there's the controversy. So I was also looking today, I had him on my podcast, and Gary Atanaki, he's got the dual momentum investing thought process where he's saying, I'd like to take both forms of momentum. And you're saying, hey, let's take some momentum and some value and combine it together. I guess what you're really saying too is that, if you take value and you take a momentum like time series, it does on the efficient frontier usually give you more return and less risk.
Yeah, it does. And, what I found, if you look at a simple, part of what I've done, part of my research is I looked at simple momentum strategies like, the one Med Faber wrote about, just a sort of a simple 200-day moving average strategy. So if you look at how just a simple 200-day moving average strategy does over long periods of time, you do very well. I mean, you beat the benchmark, you manage volatility, you compound off of lower lows, and your final sum is a great bit higher than it would have been if you had just indexed. But you still get a lot of false positives. And what I found is you can get rid of a lot of those false positives if you pair value and momentum. Because when the valuation is not very great, the market's not perfectly efficient, but it's kind of efficient. And so people tend to say, look, they get back in relatively quickly. The drawdown tends not to be too steep. It hovers right there around fair value. But when we get greatly disconnected and you have flagging momentum, that's when I get scared. And so right now, I think the greatly overvalued condition is met, and I'm waiting for that momentum to flag before I really run to the bunker.
The black swan will swim in one day. We don't know when or how, but it will come. Hey, let me shift gears in a little bit. Similar headspace, volatility and risk, and I've talked about this a lot in my world too. I'll let you run with it. So many people just perceive, and even very smart academics, that volatility is risk. not necessarily so. And not, I mean, standard deviation is just a measure of risk, can really lead people to perhaps incorrect conclusions.
Yeah, absolutely. I mean, people need to understand why standard deviation, why volatility got introduced as a proxy for risk in order to then sort of combat that idea. And the reason that it got introduced as a proxy for risk is because it helped us build elegant, beautiful mathematical models. And people could get Nobel Prizes and build their careers at the University of Chicago on ideas like this. What it's not is a very useful thing in practice. And so, chapter 10 in my book is called Risk is Not a Squiggly Line, and it helps people understand, more fundamental conceptions of risk and also ways to manage it, because it's a very poor predictor. And again, you look at a lot of these strategies, you can, there's risk and volatility are related, but it's far from a perfect relationship, and your ability to exploit that can make you a lot of money.
I had a presentation a few years ago and gave a kind of a time series momentum trend following presentation, and a very smart lady in the room. I could tell she was very smart. I was in Singapore. Everybody in Singapore is smart. And right. she raised her hand, and immediately it was the first like 5 or 6 words. I was like, okay, I know where this is going. What's the Sharpe ratio on it? It's like, it's like you just want to do the Vulcan mind meld and say, listen, you've probably had more education than I have. You probably have a higher IQ than I do, but you don't know what you're talking about. Well, I got into this. I was pitching to an unnamed large institutional investment firm recently, and they wanted to know about tracking error, and we're using tracking error as a risk proxy to a benchmark. You mean?
Yeah. So how much did it deviate from the S&P? And I said, who cares? Like, this is, and they didn't love that answer.
But that's a great issue, though. I've got one of the things I was going to ask you about before we run out of time. The benchmark issue is huge. I mean, leading one's life as just I must meet or match the benchmark. And if the benchmark's down 50%, then okay, you match the benchmark. And that's how so much of Wall Street runs their lives and makes so much money, is by matching the benchmark, even if it's down 50%, or for that matter, at the end of the dot-com bubble when the NASDAQ was down 77%, those fund managers were matching and beating or whatever the benchmark.
I mean, it does so much bad in our industry. The first thing that it leads us to do is it's how we get these low conviction, crummy, expensive, low conviction, not differentiated, quote unquote, active strategies. The reason that's the case is because Wall Street's benchmarking to the S&P or whatever it is, and they have that career risk. They don't want to differ dramatically from the benchmark. So that's one negative effect. For average, just everyday retail investors, it actually leads us to make poor decisions. I talk in the book about people who benchmark to the S&P versus those who benchmark to just the returns they need to live the life that they want to live, and show that the people who have that personal benchmark are much more likely to stay the course, to follow their rules, and end with higher closing account balances. There's just nothing good about indexing to something impersonal. And then again, when it all hits the fan, you can be happy about a 45% drawdown when everyone else got a 50% drawdown. Regardless of how it's crushed your ability to live the financial life you want to live. It just doesn't make any sense.
And sadly, I think one of the reasons that the benchmark concept sells so well is, again, right into your psychological sweet spot. People have a fear of not being exactly like their neighbor, Bob Jones. So if you're not exactly like Bob Jones, then that fear alone drives people. Whereas Bob Jones' time horizon, his strategy, whatever, could be different, not related to you, not important to you. But people get so caught up with the idea of what's the neighbor doing? What's the neighbor doing? And a good portion of all the error and the biases and whatnot that you describe in your work is all related to this monkey see, monkey do stuff, isn't it?
Yeah, absolutely. And there's a great Harvard study. I'm going to get the actual dollar figures wrong, but I mean, they basically asked students, would you rather be someone making $40,000 a year in a community where the average salary was $25,000 a year, in a neighborhood where the average salary is $25,000 a year, or would you rather make $200,000 a year in a neighborhood where the average salary is $400,000 a year? And people will take less money and better relative position. And it's crazy. I mean, it's crazy. It's all about the monkey see, monkey do thing, like you said, and our tendency to benchmark to other people. And it's interesting. I talk in the book about Isaac Newton. Isaac Newton made tons of money. He was Sir Isaac Newton, famous in his day, well respected, very wealthy. Piles into the South Sea Company, makes a ton of money, gets out early, sees that his neighbors have stayed in and that they're getting richer than he is. He piles all his money back in, loses it all in a bubble, and dies penniless because he couldn't keep his eyes on what he needed, right? He had to benchmark relative to someone else, instead of having that personal benchmark.
And so what does IQ have to do with investing success?
Yeah, there you go.
Yeah, that's a good place to end it for this conversation. Daniel, the book, The Laws of Wealth, Psychology and the Secret to Investing Success, came out in June. Looks like it's doing pretty good. Everyone can find it everywhere, right?
Yeah. Just jump on Amazon and pick it up.
Where else can we send people? You have a main website we can send them to?
Yeah, Nocturne Capital. So Nocturne with an E, like Chopin, right? And then at Daniel Crosby on Twitter.
Okay, appreciate it. Good conversation. We covered a lot of area. For never talking before, I appreciate that you were willing to run in different directions and banter back and forth. I'm sure people will enjoy it.
Absolutely. Thanks so much for having me.
And finally, my last interview for this mega episode, Meyer Statman. I hope you enjoy. In fact, I hope you enjoyed all 5 of these great guests.
Hey, Meyer, how are you?
How are you?
Good.
Apologies, I just stepped out and didn't watch the clock.
Yeah, it's quite all right. You're taking some time. I appreciate it. So let me jump right in. Your career, where you've gone, am I summing it up correctly to say that for you, your career excitements, how do we make decisions and how are these decisions reflected in markets?
Well, yes. My passion is really to make sense of the world of finance. And that, of course, involves how we make decisions and how they're reflected in financial markets. And when I look around, of course, there are many things that just don't fit together. And I try to see if I can rearrange them such that they do fit.
A big picture issue, which I thought was interesting in your book, What Investors Really Want. And it's not just money, is it? They want other things besides just the utilitarian aspect of money, which I don't think I want more than just money out of the markets. Maybe I don't know myself well enough, but I can definitely see how other people, for sure. I mean, I know people that love the excitement and all that kind of stuff. So I can see those other motivations. What do you talk about the idea, big picture, that people are motivated that the markets are more than just money?
Well, if you ask people, why do you invest? Or what do you expect from your investments? They say, well, that's a silly question. Of course, I expect one thing and one thing only, and that is to make money. But of course, the next question is, what is the money for? Why is it that people who have $1 billion strive to have another billion? They already have more houses that they can count. They surely are not going to have bigger steaks because they're on a diet. And so you have to really figure out that for people with $1 billion, it must be issues of status. Sometimes, and when we talk about status, we're talking about respect. We're talking about self-respect and respect of other people. And so you will hear rich people say something like, well, money is a symbol of my achievements. Well, what they really mean is that it makes them feel good. It increases their self-esteem. and it increases their esteem in the eyes of others. And you can see that in the United States, in particular, in the pattern of philanthropy. That is, rich people donate to universities and hospitals and museums, and then their names are placed on a building, and so it is called Lucas Hall or whatever it is, to signify that. And so they pay money to buy status. For people who are not as wealthy, we are talking about just plain middle class people, money is not just for money, it is for taking care of family. It is for saving for retirement. It is for feeling good today, even if they are in their 30s, just knowing that they are on track to retirement, knowing that if the car breaks down, they'll be able to replace it. These are some of the things that matter. Once you go beyond what is it for, it's for money, but then what is the money for? And sometimes we are willing to sacrifice money for those other things. Of course, we sacrifice money when we give it to a university that places our name on a building. We also sacrifice money when we, for example, invest in socially responsible funds that have lower returns than other funds. And we sacrifice money when we enjoy the game of trading. You know, we know from many studies that people who trade the most lose the most, and yet they make money. If I might go on, I will just say, think about golf, which I talk about in the book. Nobody is going to say that you make money playing golf unless you are a professional. People pay a lot of money to play golf. Why? Because they enjoy it. Well, to my mind, trading to lots of people is the equivalent of golf. It is just that it is legitimate to say, when it comes to golf, I pay a lot of money because I enjoy it. And it is not legitimate, it seems, to say, I trade. I know I'm losing money, but I enjoy it.
Meir, let me go into some specific examples. You've got some really nice color in your work that I thought was a lot of it that I relate to. I see much of it in my own work, but I thought you used some examples in some different ways that maybe people don't expect, or maybe they don't want to think about. And you went to the Madoff example, and I thought what was interesting is you really took to task, to some degree, the clients of Madoff, the clients that all said, well, we never could have known there was a problem. We were fooled. And you kind of point out, hold on, that you might say that, but you really can't fall on that sword.
Yeah, I think that they say that about people who fall for con games, that it is really their greed that is helping them fall into that trap. That is, if somebody stops you on the street and says, here is a thick bundle of money that I just found, and I'm just going to share it with you, and I just want you to deposit it in your checking account. Well, you know, a greed would say, wow, there are many thousands of dollars in this bundle. But if you stop for a moment and think, why would somebody stop you in the street and offer you thousands of dollars? Why would somebody write an email from Nigeria and offer you many, many millions? And when people don't stop and ask that, then they fall. And so Madoff is a perfect example. That is, what people should have asked is, if somebody offers me high returns and low risk, if somebody actually offers me that, I put down the phone, okay? Because I know that is going to be a con, or in some cases it might well be the truth, but so I'm going to give up some opportunities for phenomenal returns with low risk, but I will not fall into that trap, whereas others go for what looks like wonderful opportunities, and they end up not asking, why is it that somebody is offering it to me? How is it that they can have high returns with low risk? And then they fall. I know I use an example that I heard from my mom about a woman who borrowed a spoon and returned the following morning to bring a teaspoon with it, and said that the teaspoon was born off the spoon the night before. The following day she borrowed the cart, and then came the following morning to say that the cart died. And people who believe that spoons give birth to teaspoons should not be surprised when carts die.
Hey, I should add, you list the details in your work of the Nigerian scam. I think it's over $100 million a year. So maybe people think, oh, nobody responds to that, but a lot of money is given to Nigerian 20-something scam artists on telephones.
That is right. That is right. It is amazing that I still see, of course, those emails where Mobutu died and left me $20 million or something, and obviously what they say really is that it costs them nothing to flood my email box and yours. And they're just enough fools who say, well, maybe this one seems just right. Again, if you are greedy and if you don't ask yourself, who is the other side of the trade? Why are they offering it to me? Then you're going to fall for it. And many people fall. Many people, I mean, if you just look at active management, I invest exclusively in low-cost index funds, and my typical colleague does the same in academia. Why is it that people trade so much? Why is it that they believe that they can easily beat the market, or that a manager can help them beat the market after he or she takes their cut? Either they don't get it, they don't really understand that trading is playing tennis against an opponent on the other side, who might be an insider, or they're just overconfident in their ability to beat that opponent. I say, I never played Roger Federer. Well, so I guess that my chances of beating him are 50-50.
It's interesting. I saw this quote for the first time recently where Warren Buffett said that it was not greed that made the world go round. It was envy. And I'd be curious to your perspective there. But, in some of your work, you kind of go the direction of talking about framing. And so let's say somebody generates a 10% return on a year. Instead of viewing that, some people are going to say, hey, that's plus 10%. That's great. However, some other people, and I go back to the Buffett comment right there, some other people might say, oh, that's a 20% loss because my neighbor made 30%.
That is right. That is right. And envy is a good word here. And even more, I would say something more neutral, like status seeking. That is, when I say that I envy my neighbor because he has a fancier car, what I'm saying is that he has a status that is higher than mine, and I aspire to that status. Now, we are all status seekers. We just do it in different ways. And the difference really between people who manage to pause and be happy and people who could never be happy is that people who manage to be happy say, 10%, wow, I never expected that. Or I never expected when I was in my 20s to have so much money now. Whereas other people say, boy, yes, I do have a good amount of money, but my neighbor has more. And so they don't pause to be happy. And so just knowing when enough is enough is really an art that not all master.
I think this goes right into your world, though, too. And I'm calling you from Asia today, and a word that I learned this year was kiasu, Singaporean Chinese phrase for a fear of losing, of missing out. And it's amazing how much that drives. I mean, it's a big driver in Singapore, and other cultures, they might have a different way of describing it. But this fear of losing, the fear of missing out, is a really hard driver. People are really reluctant to accept the idea of sunk cost, aren't they?
Yeah, there is sunk cost. So first, when we talk about missing out, people are afraid of falling behind. People always watch people who are just wealthier than they are and just poorer than they are, and they dread the possibility that the ones that are poorer than they would catch up to them, and they strive to overtake the ones that have more. The issue of the reluctance to realize losses, to come to terms with losses, is a bit distinct from that. I think that we always have that sense that if we bought something for 100, expecting it to go to 120, and instead it goes to 60, that if we just realize that loss, it would expose us into being stupid for having bought it in the first place, and so we'll feel stupid and we'll feel regret, and so we tend to postpone it. And that applies to many aspects of life. One woman who heard me speak about that, she said, now I understand why I did not terminate my marriage 5 years earlier.
Yes, indeed. To kind of flip to another topic, and there's so many. It's your work is dense, and there's a lot of different areas we can go in a limited amount of time. And I just picked some of my favorite areas that I thought the audience would really like hearing your perspective on. Mental accounting. This is right in the sweet spot of where people often go wrong, isn't it?
Well, yes, it is a place where people go right and many times go wrong. That is, God planted mental accounting in us, or evolution planted mental accounting in us, not to spite us, but to help us. So mental accounting, for example, is reflected in keeping our money in different pockets. That is, we have money for retirement, and money for vacation, and money for educating the kids, and money for getting rich with the lottery ticket. That might well be useful. And it is useful, for example, in creating barriers such that we are not going to spend money that is in an account that is dedicated for our children's education on buying a sports car today and disappointing the kid later. So that is useful. It becomes less than useful. It becomes harmful when we get to misuse it. And so when I buy that stock for 100, then it goes to 60, and I have this mental account that I created for it where I'm going to feel like an idiot unless I sell it for more than 100, and then I throw good money after bad. That really is a bad thing to do, and in those circumstances, I would like to have either a rule or a good friend or a spouse who's going to say, "Hey, Mayor, this is spilled milk. This is spilled stock. Just get over it and move on. Close that account."
Mayor, I've got a few more topics I want to discuss with you, but I wonder if I might get you to paint a picture. You've gone down, this is your life's career going into these topic areas, and we're only giving it a kind of a cursory analysis right now in limited time. But what drove you? What were your early influences that brought you to this place where you were going into the behavioral finance world?
Well, I was always interested in how people behave and what makes them tick. And I suppose everyone is. You know, you grow up as a kid and you're trying to figure out why is it that somebody is my friend and somebody is not? Why is it that people behave the way they do? For many people, it is just the usual part of life, and then they move on to become physicians or lawyers or whatever they do. For me, it turned out to be a profession. That is, I get to explore why it is that I do what I do, and why is it that other people do what they do. That is, I find it really odd that some people in finance are able to separate their everyday experience from their insights about their work. So they behave as normal people, just as you described yourself, and yet when it comes to how they model people, they expect them to be rational. Well, it makes no sense. And so I use myself as my first laboratory. I ask myself, how do I behave? And instead of being mad, I just chuckle at myself and say, hey, that is pretty normal and kind of interesting, and that is not unusual. Is there something that is systematic about it? Is there something that can be generalized, that can offer insights to other people? And so that has always been something that is trying to figure out what makes people go, what is it that people want, has always been with me, and I'm just one of those fortunate people who get to do for pay what other people do for free.
Mm-hmm. Good stuff. So let me get you to put your good professorial cap on. And one of the areas in your work that I liked was I like the distinction, because sometimes people, they get so political, but you took it more to kind of a utility factor in my mind, which is you kind of said it's libertarianism versus paternalism, and with many shades in between. Why don't you describe that for the audience, this idea of libertarianism versus paternalism?
Well, the question really is whether sometimes we should let someone play our parent, even if we are grown-ups. And you can see the different societies answer it differently. So, for example, in Australia, there is mandatory retirement savings. You like it or not, you have to contribute to retirement savings. I suggested that we do the same thing in the United States, and when it appeared in some articles on the internet, lots of reactions were not just negative, but they were really angry. Professor Statman, you don't really understand America. We are the land of the free. Well, what happens is that for people like me, I imagine like you, for most people who are responsible enough, who have enough self-control, even though they can spend the money today, they know that there's going to be tomorrow, and they save. Well, libertarianism works for me and for you, but it does not work for other people. It does not work for people who lack self-control. And then the question is, should the state get and do it for them? Well, we have it in the form of Social Security, for example. You cannot opt out of Social Security. And so there's kind of a fine balance, and that balance varies across countries by culture. And, so I would say we do need mandatory retirement savings. So in this sense, I'm paternalistic. But then I say, if people want to drink 30-ounce sodas, sugared sodas, that's fine. I'm not going to be a parent here and say you cannot do that. And different people in different societies decide what the right line is between paternalism and libertarianism.
Yeah, it's interesting. We sometimes really do have this, this is America, we're all free. The libertarian aspect, which is, I like to think myself, falls into that category. But then it seems like when things go wrong, perhaps like the fall of 2008, forget individuals, the largest banking concerns in America all of a sudden need a parent and in the form of a bailout. So it's interesting how it happens.
Yes, that's another thing that is really interesting about people. First, they say, "I want to be free. I want to cross the street on my own." Then, when a car hits them, they say, where was the government to stop that?" And so some of the victims of Madoff wanted the government to pay their losses. And, they said that that's because the government, the SEC, did not catch Madoff in time. And so they expected the government to do the work of a parent. That really is just who we are. That we like to do our thing very much like kids, and then we expect to be free of any negative consequences of that. Banks do the same thing. That is, they want to be free to do what they want, but they want to be bailed out when things go down. So you can hear it in my voice. I just chuckle at myself and I chuckle at other people who do that. And so when people get all excited about this is the land of the free, I say you don't really feel that way when things go some way that you don't like.
Yeah. I was watching tonight a video from Ginger Rogers, 1933, singing We're in the Money. And I was laughing because in your book, you do go into the idea of like, hold on, there's a lot of literature writing from nearly a century ago, mapping out the same issues and foibles and all the different things that we deal with. And human nature, when it comes to markets, hasn't really changed. We haven't gotten better at this, have we?
No, we have not. We have some tools we didn't have then, but of course this desire to have high returns with low risk, that has always been with us. The desire for status has been with us since we were created. All of that has been with us, and so differences might well be in the structures. So 100 years ago, we didn't have Social Security. People of course were mad, and some people are still mad that we have that, and that the government forces us to pay into it. But if you think about people 100 years ago who got old, they were destitute, ill, perhaps dependent on their family if the family could help them. But Social Security was not created as a luxury; it was created as a necessity because it was seen that many people end up destitute in old age. And the same applies to other things, whether it is Medicare or health insurance more generally. And so, in this sense, I think that the world is getting better. That the balance between libertarianism and paternalism kind of shifts properly to account for people's needs. And in this sense, perhaps hard to say that, but perhaps politicians are smarter than citizens.
Oh, wow. I know you'll probably get like all kinds of hate mail for that too, huh?
Yeah. You know how it is. That is, kids always say, talk to 16-year-old kids and they'll tell you that their parents are stupid. And then when they get to be 22, hopefully they realize that it is they who are stupid and their parents were pretty wise.
I guess I'm unfortunate that I grew up in the Washington, D.C. area, so I have a hard time having many things positive to say. When I feel like sometimes I've seen too far behind the scenes, but I like to, deep down as Americans, I think we all want to believe that politicians are somehow trying to do the right thing, but We'll just have to wait in time and look back in history and judge. But hey, Mayor,
that is right.
Listen, what's your book? What Investors Really Want? They can find that on Amazon. Where is the best place for people to come find out more information about you and perhaps check out some papers, some of your other work?
Well, other than the book, of course, if they just put my name in Google or some other search engine, they will just find the first thing they'll find is my website, and there they will find articles that I have written, and so that is probably the best way. I speak in public gatherings on occasion. Sometimes people write about it, and so on. And there they'll find even my email address if they want to reach me.
Well, I definitely recommend the book. You put out some issues that make you think. And, one more fun one that I had to have loved is that you sometimes people probably hear about markets and whatnot and astrology. And you point out, and I think it was one of the directors or one of the fund managers for the state of California retirement system, one of the pension funds, and he was actually using astrology. One of the things he was using.
That is right. Yeah, Orange County and the manager and that county went bankrupt. But people do that again. Lots of people believe that spoons can give birth to teaspoons. So astrology is not that far from it.
Yeah. Well, listen, hey, Mayor, it was good chatting, and I appreciate you coming on today.
Sure. Good to speak with you.
Thank you.
Take care.
As I said at the top, if you did not learn something from those 5 men, you're brain dead. I know that doesn't sound very nice, but what do you want me to say? If you did not learn something from those 5 guys, you're done, you're over, you're toast. Just go away. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.